Accounting. Tips about balance sheets, gross income, and statements. Written by Gerard Howells. Narrated by Wes Grant. Chapter 1. Top 11 Small Company Accounting Tips to Save You Money and Time. There is no shortage of details to consider when you're a small business owner. Getting the back office essentials of your small business accounting practices in order early on, tracking earnings, costs, and profits, will keep you out of the weeds of paperwork and cash flow snafus, and let you concentrate on the important work of growing your business. You may be able to get away with keeping your own books in the beginning. Still, as your company grows and tax time is at the door, you might feel a little bit lost. Charges for inaccurate tax filing and sloppy bookkeeping can be high, without even mentioning the time you spend on fixing mistakes. Before running into problems, consider hiring an accountant or automate your bookkeeping practices with one of the various business accounting software tools that are readily available to you. These include Xero, QuickBooks, FreshBooks, and Wave. Bookkeeping is a required task of all services. It helps you manage your operations, plan ahead, and prevent an audit by giving the IRS, Internal Revenue Service, what they need to keep approaching your long-term goals and enhance profits. Follow these proven small company accounting pointers. You might be tempted to position the bookkeeping and accounting practices at the bottom of your to-do list, but following the right treatments can set your business up for success. Here are the leading small business accounting tips and tricks. 1. The separate business and personal expenses. Having a devoted business checking account for checking and savings saves you valuable man-hours when it is time to tally up deductible business expenditures. At first, you should get used to using different bank accounts for business and for personal purchases. If you're contributing capital to your business out of your personal assets, make sure you clearly document the contribution. Keeping a dedicated business bank account and business charge card will also help you limit legal exposure to more business financial obligations. If you have a limited liability company, LLC, or corporation. In general, you cannot deduct your personal costs on a business income tax return. If you use the property both for business and also for your personal usage, like a car or office, then the part of time you use the property for the business is deductible. Otherwise, subtracting your personal expenses on a business tax return isn't enabled. The charge can be as high as 75% of the additional tax amount owed. 2. Track every expense. Label and classify each expenditure and track your capital to ensure that you can take full advantage of tax write-offs and credits. The dollars build up rapidly and you can easily lose a lot of money. Just use your business credit cards for all acquisitions and you will not wind up with a wallet loaded with paper invoices to sort through. That also implies you can earn rewards and cash back for your spendings. Accounting software applications will also store copies of checks and invoices that you've paid. Anytime money is your only option, file digital copies of receipts in your accounting software application. Your chosen accounting method will impact when to record expenditures and salary. 3. accurately record income. Loans, profits from sales, and other money infusions are easy to lose track of, but you really need to keep track of all your inbound cash flow. If you don't, you could end up underpaying your taxes, and then it could cause avoidable Internal Revenue Service penalties. As with your expenditures, your accounting technique will identify precisely when to make a record of salary. 4. Consider hiring a professional, even if temporarily. Hiring an expert assistant or accounting professional, even for just several hours a week or per month, can make a big difference. The work of a bookkeeper and accountant overlap, though an actual bookkeeper is generally concerned with recording and categorizing salary and expenses. An accounting professional might also file taxes and help you with strategic planning. A specialist will keep your records current and organized, and a pro is better geared up to know more about potential charges, loopholes, or added tax reductions for which you may be eligible. Comprehending different Internal Revenue Service provisions and requirements can help you get tax benefits and save some time. In fact, the average small business owner can bring in about $320,000 in new business yearly by unloading accounting duties to a pro. And make sure that when you do hire an accountant, they speak to you in a way that you can comprehend. 5. Automate accounting practices with accounting software applications. Accounting software is a great tool for practically any small business. You can use it by yourself or give secure access to your bookkeeper or accounting professional, should you choose to employ one. QuickBooks is the best known accounting software, though there are some littler competitors now too. You should have the ability to link your checking account or credit card to any good accounting software application. The software will then track your salary and expenses, categorize them, allow you to send out and pay invoices, and create reports. QuickBooks even has a Pro Advisor program to help you find a local QuickBooks professional if necessary. 6. Dedicate time to update your books. Block out some weekly time in your agenda to get needed documents in order and stay away from letting invoices and invoiced receivables pile up. Make sure to adhere to the time you have reserved. That can save you a lot of catch-up work as tax season nears. Accounting software applications such as QuickBooks can save you lots of time here by automatically classifying salary and expenses and reconciling your bank accounts and credit cards. 7. Keep tabs on labor costs. Paying employees, including yourself, may account for as much as 70% of a company's total budget. Keep in mind of overtime, benefits, and other advantages you offer to prevent over- and underpaying. Your accounting professional or accounting software application should also be able to help you calculate and pay your payroll taxes, which have different guidelines and due dates than income taxes. 8. Expect major costs. Computer upgrades, device replacement, and tax due dates shouldn't come as a surprise. Bigger capital spending usually turns up during slower months, so you should plan ahead to keep away from a money crunch. The bright side is that an Internal Revenue Service provision called Section 179 lets you deduct up to $1 million of business property and devices in the year of purchase, instead of depreciating the equipment year after year. So even if you feel the squeeze of large purchases now, you may benefit from tax breaks later. 9. Maintain stock records. Theft costs U.S. organizations $50 billion every year and can shake off your books. Avoid misplacing products or theft by remembering the dates on which you bought them, stock numbers, purchase rates, dates sold, and sale prices. The more organized, the better it is. You can buy standalone inventory management software applications to help you with this job, or many accounting softwares incorporate these inventory management tools. 10. Act on billings and receivables. Just because you have sent out a billing does not mean you'll get paid. Avoid paying too much on taxes and hours spent sorting through your earnings account and receivables listing by then circling back with suppliers who owe you cash. Send out billings right after a job to increase the chances of timely payment. And follow up with friendly reminders as the due date approaches. You can even offer early payment discount rates to incentivize your consumers to pay fast. Accepting online payments and using cloud-based accounting software can also help you automate this process for you. 11. Create financial projections for future years. Even if your business is economically sound today, you will want to ensure things stay positive. Using financial projections and reports, like a typical size analysis or general profit and loss statement, you can estimate where your firm will be the following year or even 2 or 3 years down the road. Financial projections can help you find out where to invest business profits and whether and when you'll need to start looking for a firm loan. Financial forecasting can be tricky because you need to figure out how expenditures can change as a result of natural forces, that is, inflation, as well as choices by your clients. The exact same is true for income, where you will have to factor in price boosts and the number of clients marketing will create each year. Sitting down with your accountant or using accounting software are the best ways to develop sensible financial forecasts. Small company accounting tips. Follow these tips to keep your business growing. Financing is the foundation of any business, so these small company accounting suggestions and tricks are important to business success. Connect with an accounting professional if you do not already have one, and ask for the best place to begin. Alternatively, you can try accounting software like QuickBooks, which takes the uncertainty out of small business accounting. By following these accounting ideas for startups and recognized businesses, you will guarantee that your firm is financially healthy now and for several years to come. Chapter 2. Balance Sheets. Whether you're doing your own accounting with some accounting software, or you employed an accountant to prepare your monetary declarations, you have very likely seen the balance sheet. The balance sheet, in addition to the income statement and declaration of cash flows, provides an introduction of a business's monetary standing. Why is the balance sheet important? It's used by business owners and financiers to see what the firm owns and what it owes, and its main use is to track earnings and spendings. The balance sheet provides an image of a firm's financial standing at a specific moment. Next, we'll demystify the balance sheet. What is a balance sheet? A balance sheet is one of the crucial monetary statements used for accounting, and it's divided into two sides. On the left side, the firm's assets are reported. The right side shows the business's liabilities and shareholders' equity. The line products for each side are noted in order of liquidity, with the more liquid products, meaning money and inventory, are noted before accounts that are more illiquid, that is, plant, property, and devices. The balance sheet is a photo of the business's monetary standing at a single time. For example, an accounting period is usually 12 months long. The line items or accounts on the balance sheet would show the number of assets and liabilities at the final moment of the accounting period. 1. Understand what elements you need to include and how they function. Here are the components that are required on your balance sheet. Assets. Assets include both existing assets and non-current assets. Existing assets, cash and cash equivalents, or in other words, short-term government bonds, treasury costs, and money market funds, receivables, and stock. Non-current assets, property, plant, devices, long-term investments, and intangible assets, e.g., patents and licenses. Liabilities. Both current and non-current liabilities are included in the liability section of the balance sheet. Present liabilities. Accounts payable, notes payable due within the year, and existing maturities of long-term debt. Non-current liabilities. Long-term notes payable, deferred tax liabilities and bonds payable, and long-lasting debt. Shareholders' equity. Shareholders' equity, also referred to as shareholders' equity, includes share capital, the amount of cash a business gets from its shareholders for business purposes. Retained earnings, the amount of a firm's profits that aren't dispersed to investors as dividends. The funds are reinvested in the business instead. 2. Figure out the time period you are reporting on. Since a balance sheet's main role is for reporting, you'll be putting together these on an ongoing basis, more than likely on a per quarter frequency. Choose the date that you'll be compiling the report. This will be your reporting date. On the reporting date, you'll be looking back at the numbers for a previous period, one that is already solved. That time period is called your reporting period. For instance, if your reporting period is Q1, January the 1st to March 31st, your reporting date might be April 1st of the exact same year, or another date depending on your specific needs. 3. Determine your assets as of your reporting date. Organize your assets into 2 categories, present and non-current, and represent each asset as a line product within the appropriate category. Then, you will subtotal your classifications and total them together. 4. Recognize your liabilities since your reporting date. These will also be represented as individual line products within existing and non-current categories. Then, you will subtotal and total these the same way you did with your assets. 5. Calculate shareholders' equity. You'll then want to include the share capital you get from financiers as well as kept earnings. You may really need to consider if the following must be factored in depending on your situation: common stock, preferred stock, treasury stock. 6. Compare total assets against liability and equity. On the balance sheet, assets equals liabilities plus investors' equity. You'll want your balance sheet to include this computation to provide insights into your financials. Balance sheet analysis. The balance sheet is essential to determine a business's liquidity, leverage, and rates of return. When current assets are greater than present liabilities, This means the business can cover its short-term financial obligations and is very likely in a pretty good monetary position. The term leverage is used to define how much of a business's capital originates from debt. However, how does the balance sheet affect a company's leverage? One of the leverage ratios, the debt-to-equity ratio, divides liabilities from shareholders' equity to show how leveraged a business is. Other estimations like return on equity and return on assets can be determined with the financial information noted in the balance sheet. Both of these solutions tell investors whether they will get a return on the cash they invest in the firm. An analysis can also be performed by taking a look at the financial declarations from 2 or more accounting periods. For example, if there's a substantial percent reduction in the firm's money, it could be experiencing monetary problems, and it may not be smart to invest in the business. The balance sheet is one of the 3 monetary declarations that offers an introduction of your business's monetary standing. If your business is doing well, investors can look at your balance sheet and see if you have a rewarding business they wish to invest in. Chapter 3. Gross Income. The wage or salary you receive before taxes and reductions is called gross earnings. Gross earnings can be broken down by different time periods. That is an example. You could look at gross earnings at an annual or monthly rate. Gross yearly income. Gross annual income is the monetary amount an individual makes each year before reductions and taxes are taken out. For instance, when you get a job offer from an employer, the gross annual income is the amount listed on your offer letter or employment contract. Now that we have defined gross annual salary, let's look at gross month-to-month income. Gross month-to-month salary. Gross month-to-month salary is the amount of money an individual makes each month before taxes or deductions are deducted. Your gross monthly salary can be determined with the following formula. Gross regular monthly salary equals yearly salary divided by 12 months. Gross regular monthly salary is usually used by lenders and credit card businesses when figuring out if you receive an offer and how much the offer should be. Let's go into the difference between gross earnings and net income. Here's an example to show the distinction between gross and net income. Let's say an individual made $1,500 and there were $400 in deductions. Their gross earnings is $1,500 and net income is $1,100. For people, understanding your net earnings is handy for budgeting. For organizations, net earnings, also called net income, is a figure used when examining income versus expenditures. This analysis gives a great image of the monetary health of a company, which is important not just for the management group, but also lending institutions and financiers. What is adjusted gross income? Adjusted gross income, AGI, is the amount of cash you have made throughout the year from your job, self-employment, dividends, or interest from a checking account, minus changes like IRA contributions, spousal support payments, tuition, and more. AGI is used throughout the tax preparation process. Adjusted gross earnings is used as a starting point for calculating your taxes. It's how much cash you've made in a year minus adjustments that include the following: alimony payments, individual retirement account or retirement plan contributions, student loan payments, self-employed health insurance payments, tuition and charges. Depending upon how you're submitting your taxes, you might need to use your customized adjusted gross income instead. Modified adjusted gross income, MAGI, is your AGI with certain reductions added back in. Gross income for a business. Gross income for individuals and companies are a bit different. For a firm, gross earnings or gross margin is computed by subtracting the cost of items that have been sold from the firm's sales. Cost of items sold is the expenditure of creating the product, e.g., labor expenses and basic materials. And sales describes the financial amount a company has after selling its product and services. Whether you're taking a look at your individual gross income or the gross earnings of your business, comprehending your salary is necessary, especially when completing tax forms and creating a budget plan. Gross margin and profit margin. I do not actually want my business to have higher profits, said no entrepreneur ever. For most company owners, their main goal is to bring in as much revenue as possible and to increase the earning potential of their business with time. While having a strong grasp of how much cash your firm is bringing in is necessary, income values alone don't supply enough info to help you assess the health and growth potential of your small company. What is profit margin? To acquire a strong understanding of your firm's bottom line, the profit margin is an essential data point. Profit margin gauges what portion of your company's net earnings comes from sales. Because this figure also factors in your business costs, it measures how well your company is able to control costs relative to sales. Use the following formula to determine the profit margin for your business. Let's break down the numbers of this formula further. Net earnings. To find net income, deduct total expenses from overall revenue. Net sales. Determine net sales by deducting total returns or refunds from total sales. The numbers needed to calculate these values can all be found on your firm's balance sheet. Here's an example. An entrepreneur with a boutique baking business selling specialty cookies made $100,000 in gross sales in 1 year. The firm issued $5,000 in refunds, bringing their net sales to $95,000 for the year. That same year, the company had $70,000 in expenses, bringing net income to $30,000. With these variables, here's how we determine the profit margin for the shop baking firm. Profit margin equals $30,000 divided by $95,000 times 100 equals 31.5%. The profit margin we calculated shows us the shop baking business had the ability to transform 31.5% of sales into profit. While this is a fairly straightforward example, profit margin values and intricacy can differ depending upon the company because costs vary significantly. It is necessary to note that there's no single profit margin number that separates a good profit margin from a bad profit margin. Truth be told, how good your firm's profit margin is largely depends upon your market. In 2019, commercial leasing firms had some of the greatest documented profit margins, with approximately nearly 50%. Still, producing businesses had a typical profit margin of only 10%. This is likely as a result of the higher expenses for materials and labor contrasted with commercial leasing, which tends to have lower operating costs. When trying to assess how well your firm is performing based upon profit margins, look at the average profit margins for your industry. In addition, the maturity of your business also contributes. For new and scaling firms, expenses tend to be higher, which can cause lower profit margins compared to more established firms. Now that we comprehend the essentials of calculating a firm's profit margin, Let's discuss the other estimations that may be handy for figuring out the success of a small company: gross margin and net profit margin. What is gross margin? This variation of the profit margin formula calculates how much profit your firm has after representing the cost of items sold. Cost of goods sold includes direct expenses related to the production and sale of your company's product. This value does not include non-operating expenses. Let's say your firm made $2 million in revenue this year. The overall costs associated with your product were $650,000 for the year. Here is how you would calculate gross profit margin. Gross margin equals $2 million minus $650,000 divided by $2 million equals 67.5%. Preferably, your firm's gross profit margin should be high enough to cover your operating costs, allowing some profit to be left over. Any additional funds can be used for other expenses, like dividend payments or marketing collateral. This value can also be practical for determining the profit margin of a particular product or offering, instead of finding the margin for the firm as a whole. To determine the gross profit margin of a particular item, use the income made from the sales of the product and the costs associated with the production of the item. What is net profit margin? Net profit margin computes how much of your overall income is profit. Rather than accounting for just the direct cost of creating and selling a product, like gross profit margin, net profit margin accounts for all expenses. If your business earns $2 million in profits and has $1,500,000 in total expenditures, you can determine your net profit margin as net profit margin equals $2 million minus $1,500,000 divided by $2 million equals 25%. For many organizations, it is expected to have a net profit margin that is lower than your gross profit margin. That is because of the addition of non-operating costs. If you find that your net profit margin is lower than you would like, or lower than what's needed for the health of your business, you can try to find ways to minimize your expenses, which is a simpler variable to manage than trying to drastically increase revenue in a brief amount of time. Gross margin versus profit margin. Now that we understand what gross margin and profit margin are, let's go over the resemblances and differences between the two. Both gross and profit margins offer important insight into the financial health of a firm. Those values gauge how effective a business presently is at making a profit based on the goods and services sold. The distinction between the two involves the aspects used to identify success. Gross margin shows how successful a business is above and beyond how much they spend to create and sell their products. Profit margin measures how much a company earns from each sale they make. Comprehending both is essential for getting a well-rounded view of the monetary performance of your firm, and are convenient data points for determining both short and long-lasting financial strategies. Chapter 4. Salary Statements. A company's income statement acts as its progress report. It reveals the fundamental parts of any organization that you can't instantly see on the surface area. This extensive guide to salary declarations will offer everything you need to know about a company's sales activity, its cost of producing or purchasing, and its expenses. The salary statement shows the financial activities of the business during a specific accounting period, which can be month to month, quarterly, each year, or some other finite time period. In a nutshell, it's what comes in, what heads out, and what's left over at the end. It is also generally the first document in a yearly report or financial filing. As a seller, understanding a business's monetary health will allow you to build a business case for the product or service you are selling. In order to effectively lead consumers to mutually helpful decisions, you must have the ability to understand and master financial metrics. Rather than offering unclear ideas about how much money your firm can save the prospect, you will have guaranteed figures to support your claims. If a firm's stock is publicly traded, it's lawfully needed to file monetary disclosures with the Securities and Exchange Commission. The SEC's search feature will allow you to search for firms and their financial filings and will also enable you to request updates on new filings. What is an income statement? The salary declaration records a firm's profitability and tells you how much cash a corporation made or lost. The salary declaration reports incomes over time, so interested parties can assess how the firm is doing over a particular time period. Usually, an income declaration shows 3 accounting periods, the existing one plus 2 former ones. The broad span of 3 periods enables users to examine the company's earning patterns gradually. A balance sheet reports a firm's assets, liabilities, and equity to determine if it has enough liquidity to cover its financial obligations. It's a snapshot of the company's monetary standing at a single time. And the income statement takes a look at income and expenses over an accounting period, which is usually 12 months. It reports the firm's net earnings and loss for that period. The main usage of the income declaration is to figure out if the business has enough profit to pay its liabilities. Salary statement format. There are 2 types of salary declarations: single-step and multi-step income declarations. No matter which type you are creating, the salary declaration includes 5 key elements. Sales or earnings. Overall amount earned by selling the business's service or products. It is the overall of all the sales or revenue accounts. The leading line of the report might use the term sales or revenue earnings interchangeably. Either is accepted. Cost of products sold. Total amount spent to purchase or make the items or goods that were sold throughout the given time period. Gross profit. Amount of cash a company earned before operating costs, figured by subtracting the cost of products sold from sales or income. Operating expenses. Amount of cash spent on running expenses such as salaries, administrative costs, energies, or advertising. Net earnings or loss. Whether the company earned a profit or a loss during the specified period, figured by subtracting overall expenditure from gross profit. Also referred to as the profit and loss statement, income statements usually include many subcategories and, consequently, a lot more line products. Even so, the document comes down to salary, expenses, and the difference between the two. Income statement example. Income is always listed before costs, and the firm's bottom line is exactly that. It's the last line of the document. Let's take a look at an income declaration, or declaration of operations. Here are some things to keep in mind when reading an income statement. The report very likely won't include minus signs to show reductions, though it may use parentheses to signal them. The last profit will have a double underline so you can quickly identify it, but it might be called revenues, income, surplus, or net earnings rather than profit. You won't have the ability to tell how many unique sales were made, only how many different clients purchased from the company, and how the sales were distributed over a specific amount of time. Earnings gets counted when the items are provided, not when the customer pays for them. If the bottom line is a negative number, then the company suffered a loss over the time period in question. How to prepare an earnings statement. Determine a time frame to report on. Compute the revenue amount. Add up the expenditures. Figure out any secondary expenses or earning products. Compute net earnings. Declaration can be prepared on a regular monthly, quarterly, or annual basis. Before you can prepare an income statement, you'll need to identify how much revenue your business generated and the expenditures it incurred over the selected accounting period. While there are usually many line items in the salary declaration, it can be summed up with the following formula. Revenue earnings minus expenditures equals net income. Understanding the income statement. If you are tasked with examining an income statement, begin by checking the math. The only mathematics skills you need are addition and subtraction to validate that the numbers are calculated properly. Whether you find an error or not, adding and deducting the values will help you increase your comprehension of how the entries mesh. 1. Find the bottom line. First, find the company's bottom line. A positive number means that the firm made more than it spent, and it has the resources needed to pay its staff members and its bills. The company is considered in the black. If the bottom line has a negative in front of it, is printed in red, or is confined in parentheses, then the business spent more than it earned, and it is essential to comprehend why. The company is considered in the red. A net loss is not always catastrophic, especially in the case of startup companies which have higher expenses without profit in the first couple of years. Likewise, cyclical services like farming have different yields year after year and should expect to see up and down years. The key is to expect patterns that suggest the firm does not have enough money to fund its costs. 2. Determine income. Revenue is normally the easiest part of the declaration because there is a single number that reflects all the cash a business made. Increasing income is typically the fastest way to improve profitability. Check to see that the salary makes a lot of sense for the business in question. Watch for one-time gifts that aren't sustainable because they are not insured to repeat. Then, look for one-off income sources that might not repeat, like unique events that do not happen each year. Continuous, foreseeable earnings are the most preferable. 3. Evaluate expenses. Costs will generally include salaries, incomes, lease, insurance coverage, interest, and supplies. The biggest expenditures differ based on the business type. For service companies, incomes will be the biggest, but for production, supplies and materials are the largest. Look for illogical items. In a company with just a few employees, are the salary expenditures suddenly high? This is something to watch on. 4. Look for trends. Since salary declarations normally include 3 reporting periods, look for efficiency over the course of those 3 periods. If the file does not show the percentage change in each classification, compute it by figuring out the distinction between the 2 figures in question, and after that, dividing that number by the original number. Multiply your answer by 100. If the answer is negative, the change represents a loss. Think realistically about the numbers that are reported on the statement and seek explanations for things that don't make a lot of sense. Sometimes there will be logical clarifications. In other cases, disparities may exist. Consider that when Lehman Brothers applied for personal bankruptcy in 2008, the company had $639 billion in assets, and its income declaration made the company appear profitable. 5. Draw conclusions. When a company's earnings well outmatch its costs, that firm can be said to have a high profit margin. High profit margins suggest that the company is controlling its expenses well, or that its revenues are growing much faster than its expenditures. These businesses typically have an advantage over their competitors, just because they have a much better cushion during downturns, and they typically have the resources to enhance their market share throughout tough times, emerging even stronger later. 6. Understand the metrics. Sales reps should be able to demonstrate the business value of a service or product to the decision makers within a business. You should demonstrate the return on investment you can provide in order to convince them to purchase. Sales experts who don't understand finances will find it hard to sell effectively simply because they don't comprehend the monetary benefits of their service or product. They'll find it tough to talk without the ability to comprehend concepts such as ROI, capital investment, or business expenses. B2B selling in particular requires that salesmen show measurable savings in time, effort, or cash for the prospect. Sellers who cannot properly comprehend how firms run their finances will struggle to show financial value to their customers. 7. Solve problems. Understanding your prospect's net worth and liabilities will help you certify your potential customers and figure out whether they have the budget plan to manage what you're offering. Your capability to comprehend your potential customer's financial circumstance will help you talk to them in pertinent terms and prove your item's worth. Chapter 5. How to define, find, and record sales returns and allowances. Your salary declaration may be the most appropriate file to consider when evaluating the health of your business, the effectiveness of the sales techniques you're employing, and the state of your firm's future. That's why it is important to understand the products that turn up on one, what they mean, and how to find and make a record of them. Sales returns and allowances represent one of the most crucial classifications you'll find on an income declaration. They're essential in checking the quality of your product, consumer satisfaction with your business, and the profitability of your sales efforts. Here, you will get a picture of what those terms mean, what those figures are then used for, and how to record them on your income statement. A sales return occurs when a purchaser sends an item back to the seller for a partial or full refund. An allowance is a retroactive discount a customer receives when they get in touch with a business about a small but visible defect with its item. Both are subtracted from a business's gross sales to calculate net sales. Comprehending your sales returns and allowances and how to find them rests on your understanding of a couple of terms. The first term is debit, meaning an addition to an expenditure or possession account, or a reduction to a liability or equity account. In the framework of returns and allowances, it means expanding your returns and allowances account. The reverse of debiting is crediting, which entails increasing a liability or equity account, or decreasing an asset or expense account. In this context, it means increasing your money or accounts receivable figures, depending upon if the buyer in question paid with cash or credit. With those terms in mind, here's a picture of how to make a record of sales returns and allowances. How to record sales returns and allowances. Recording sales returns. Recording a sales return means reversing both the profits recorded at the beginning of a sale and the associated cost of expenses of items sold. To reverse the return's related earnings, you need to debit your sales returns and allowances account by the amount of profits generated by the original sale. After this, you need to credit your receivables or money account by the exact same figure. For instance, let's say there's a business that produces automated electrical hard-boiled egg-making machines. A purchaser saw the product and thought it looked a lot like a UFO, which looked like the coolest thing ever at the time. They bought one on the spot for $250 with their charge card, but they were so caught up in the frenzy brought on by the item's next-level spaceship design that they forgot they disliked eggs. Upon getting the machine and seeing how insanely not practical their impulse buy was, they sent it back. Once the firm received the return and confirmed that the buyer sent it back within a time frame that was in keeping with its return policy, it would send out the customer their cash back. Then the company's accounting professional would debit its return and allowances account $250 and credit $250 to its balance dues. Recording sales allowances. Accounting for a sales allowance is essentially similar to representing a sales return. Ought to a client be offered allowance by a company, whether it is a discount for paying an invoice early, a partial refund for keeping a defective item, or any other sort of minor return, the refund they get is debited to that firm's returns and allowances account, and then the allowance the consumer receives is credited to the firm's accounts receivable. For example, if a purchaser were to purchase the aforementioned hard-boiled egg machine and notice only 5 out of its 6 egg cooking modules are functional, they may request for an allowance. The firm, in the interest of its commitment to customer care, offers a $20 partial refund. The purchaser accepts. The firm sends them the money, and the accountant debits $20 to its sales and allowances while crediting $20 to its balance dues. Sometimes firms might not include sales returns and allowances as a different account. Instead, they record sales returns and allowances by straight debiting their sales accounts before crediting their balance dues or money account. It's critical to understand sales returns and allowances when figuring out how your business is doing and where it might be going. If your returns and allowances are disproportionately high relative to your sales, there could be defects in your product or the general public's perception of your firm. Always audit these items. If you need to know if it's time to shake up your sales process or pay more attention to item quality, sales returns and allowances can supply exceptional reference points to help dictate where you really need to go. This has been Accounting Tips About Balance Sheets, Gross Income, and Statements. Written by Gerard Howes. Narrated by Wes Grant. Copyright 2020 by Gerard Howes. Production copyright by Gerard Howes. Accounting. Dividends, Debt, and Financial Risks Explained by Gerard Howes. Narrated by Wes Grant. Chapter 1. What are dividends? In accounting, dividends usually refer to the money dividends that a corporation pays to its stockholders or investors. Dividends are typically paid quarterly, but could be paid at other times. For a dividend to be paid, the corporation's board of directors must officially approve/declare the dividend. For this reason, the board of directors may choose that a dividend won't be announced. Definition of dividends. It is necessary to note that the dividends announced and paid by a corporation are not an expenditure of the corporation. Rather, dividends are a distribution of the corporation's earnings. This explains why state laws very likely need corporations to have a credit balance in retained earning before declaring and paying dividends. Virtually speaking, the corporation must also have enough cash readily available to meet its current and future needs. While all corporations have common stock, some corporations will also have their preferred stock. In that circumstance, the preferred investors must get their dividend before the common investors. Declaring a dividend. When the board of directors announces a dividend, it will result in a debit to retained earnings and a credit to a liability such as dividends payable. When the corporation pays the dividend, dividends payable will be debited and money will be credited. Because retained earnings belongs to shareholders' equity, the statement and payment of a dividend reduces the corporation's assets and its shareholders' equity. How are dividends paid when there are dividends in arrears? When a corporation has dividends in arrears on its cumulative favored stock, it must first pay the past omitted preferred dividends and then the existing year's favored dividends before it can pay its common investors any dividends. For instance, if a corporation has cumulative favored stock with an annual dividend of $10,000 and it has left out the dividends for the past 3 years, there is $30,000 of dividends in arrears. In order to pay any dividend to its common investors, the corporation will have to first pay its preferred investors $40,000. That is the amount of the past omitted dividends of $30,000 and the current year chosen dividend of $10,000. Using the info above, but assuming that the corporation pays a total of only $5,000 in dividends in the current year, the favored stockholder should get the whole $5,000 and the dividends in arrears will be $35,000 at the end of the current year. What does the term arrears mean in accounting? In accounting, arrears are used in at least 2 circumstances. One use includes the past, omitted dividends on cumulative favored stock. If a corporation stops working to declare the favored dividend, those dividends are said to be in arrears. The dividends in arrears must be disclosed in the notes, footnotes, to the financial statements. Cumulative favored stock needs that any past omitted dividends should be paid to the favored stockholders before the common stockholders will be paid any dividend. Another usage of the word arrears occurs with annuities. An annuity is a series of equal quantities occurring at equal time intervals, like $1,000 each month for 20 years. If the recurring amount comes at the end of each period, the annuity is described as an annuity in arrears or as a common annuity. A loan payment schedule is typically an annuity in arrears. For example, you borrowed $10,000 on September the 30th, and your first month-to-month payment will be due on October 31st. The second payment will be due on November 30th, and so forth. What is a normal annuity? In accounting, an ordinary annuity refers to a series of identical money quantities with each amount happening at the end of equal time intervals. An example of a regular annuity is the series of semi-annual interest payments that become part of a bond payable. For instance, a 10-year bond with maturity amount of $10 million and a stated rate of interest of 6% will require interest payments of $300,000 at the end of each of the 26-month time periods. Another example of a common annuity is a mortgage having a fixed interest rate and a series of equal, regular monthly payments that will begin 1 month after the loan is granted. Therefore, a 15-year mortgage will lead to a common annuity of 180 equal, regular monthly payments, with the first payment due around 30 days after the loan is made. A regular annuity is also called an annuity in arrears. What is an implicit interest rate? Meaning of implicit interest rate. An implicit rate of interest is one that is not mentioned explicitly. Example of implicit rates of interest. Presume that I loan you $4,623, and you accept and repay me by giving me $1,000 at the end of each year after year for 6 years. Certainly you are paying interest, though our arrangement did not describe any interest, nor did it mention a rate of interest. To find the rate of interest that is implicit in this plan, you need to perform what's called a present value estimation. This can be done through the application of a monetary calculator, software, an online calculator, or present value tables. How do I calculate the after-tax cost of money debt? Definition of after-tax cost of financial obligation. The after-tax cost of money debt is the interest paid on the money debt minus the income tax cost savings as a result of subtracting the interest expenditure on the firm's tax return. Example of after-tax cost of debt. Let's presume that a regular U.S. corporation has a loan with an annual rate of interest of 10%. An incremental tax rate of 30%, combination of federal and state. If the corporation has a loan of $100,000 with an annual rate of interest of 10%, the interest paid to the lending institution will be $10,000 each year. That interest cost will minimize the corporation's taxable income by $10,000, thus saving the corporation $3,000 in salary taxes. 30% tax rate on $10,000 reduction in gross income. The after-tax cost of the money debt is calculated as follows. $10,000 paid to the lending institution minus $3,000 of salary tax savings equates to a net cost of $7,000 per year on the $100,000 loan. Basically, this means the after-tax cost is 7%. $7,000 divided by $100,000 a year. Using the example above, the after-tax rate of interest can also be computed. The formula for the after-tax rate is the loan rate of interest of 10% minus 30% tax cost savings on the 10% rates of interest equals 10% minus 3% equals 7%. Chapter 2. Equity and Debt. What is the distinction between equity funding and financial debt funding? Definition of equity financing. Equity financing includes increasing the owner's equity of a sole proprietorship or increasing the shareholders' equity of a corporation to get an asset. When a corporation issues added shares of common stock, the number of issued and impressive shares will increase. That increase will cause the previous shareholder's ownership portion to be reduced. Meaning of financial obligation financing. Debt financing means borrowing cash so as to obtain an asset. Funding with financial debt is described as financial leverage. Using money debt funding enables the existing investors to maintain their percentage of ownership, since no new stock is being issued. Even so, the additional money debt adds risk and may lead to higher interest rates for future loans. Financial debt financing typically comes with strict conditions or covenants concerning interest and principal payments, preserving certain monetary ratios, and more. Failure to meet those conditions can result in serious effects. In the U.S., an advantage of financial debt financing is that the interest on the financial debt is earnings tax deductible expense. This income tax savings will partly balance out the interest cost on the debt. What are certain examples of financing activities on the capital declaration? Definition of funding activities. Financing activities reported on the declaration of cash flows, SCF, involve changes to the long-lasting liabilities, investors' equity, and short-term loanings throughout the period displayed in the heading of SCF. Examples of funding activities. Sources of cash provided by financing activities include obtaining money on a short-term basis and/or long-term notes basis from a bank or other loan services. Issuing bonds payable. Issuing typical stock. Issuing preferred stock. Sale of treasury stock. Other boosts in long-lasting liabilities and investors' equity. Uses of money reported in the funding activity section of SCF include repayment of short-term loans and/or long-lasting loans, retirements of bonds payable, purchase of a business's own stock, treasury stock, statement and payment of dividends, other declines in long-term liabilities and shareholders' equity. What is the financial debt ratio? Definition of debt ratio. The money-debt ratio is also referred to as the debt-to-possession ratio or the total debt to overall assets ratio. Hence, the formula for the financial debt ratio is overall liabilities divided by overall assets. The financial debt ratio suggests the percentage of the overall possession quantities as reported on the balance sheet that is owed to financial institutions. The bigger the debt ratio, the greater is the firm's monetary leverage. The proper debt ratio depends on the industry and aspects that are unique to the company. Example of debt ratio. Assume that a corporation's balance sheet reports amount to liabilities of $60,000 and total assets of $100,000. The corporation's debt ratio is 0.60, or 60%. $60,000 separated by $100,000. What is the debt to total assets ratio? Definition of debt to overall assets ratio. The money debt to total assets ratio is an indicator of a company's monetary leverage. It tells you the portion of a firm's overall assets that were financed by lenders. Simply put, it is the total amount of a firm's liabilities separated by the overall amount of the company's assets. Bear in mind, financial debt includes more than loans and bonds payable. Debt is the overall amount of all liabilities, current liabilities and long-term liabilities. Example of debt to overall assets ratio. Let's assume that a corporation has $100 million in total assets, $40 million in total liabilities, and $60 million in investors' equity. This corporation's financial debt to total assets ratio is 0.4. $40 million of liabilities divided by $100 million of assets, 0.4 to 1, or 40%. That suggests 40% of the corporation's assets are being funded by the financial institutions, and the owners are providing 60% of the assets cost. Usually, the higher the debt to total assets ratio, the greater the monetary leverage and the greater the risk. How to be used. As with all monetary ratios, it is best for a company to compare its debt to total assets ratio to its ratio at an earlier date, its targeted ratio, its goal, the ratios at firms in the exact same industry. What is leverage? In accounting and financing, leverage describes the application of a considerable amount of debt and/or credit to acquire an asset, run a business, get another company, and so on. Usually the cost of borrowed money is much less than the cost of obtaining added shareholders' equity. As a result, it is generally smart for a corporation to use some debt and leverage. Maybe this is just one of the reasons that leverage is also referred to as trading on equity. Financial ratios such as debt to equity and debt to total assets are signs of a corporation's usage of leverage. In these ratios, money debt is the total amount of all liabilities, existing and non-current. This indicates that a corporation's money debt includes bonds payable, loans from banks, loans from others, accounts payable, and all other amounts owed. Chapter 3. Trading and Related Questions. What is trading on equity? Meaning of trading on equity. Trading on equity, which is also referred to as financial leverage, occurs when a corporation uses bonds, other debt, and favored stock to increase its profits on its common stock. Example of trading on equity. To highlight trading on equity, let's presume that a corporation uses long-term debt to buy assets that are expected to earn more than the interest on the debt. The earnings in excess of the interest expenditure on the new financial debt will increase the revenues of the corporation's typical shareholders. The boost in earnings suggests that the corporation achieves success in trading on equity. If the freshly bought assets earn less than the interest expense on the new money debt, the revenues of the common shareholders will reduce. There is a limit to the percentage of debt that can be added before the corporation's financial future is endangered. What is a stock split? Definition of stock split. A stock split usually describes a corporation dividing its existing number of shares of typical stock into a greater number of shares. For example, a corporation with 100,000 shares of stock before a 2-for-1 stock split will have 200,000 shares after the split. An investor owning 100 shares before the stock is split 2-for-1 will have 200 shares after the split. Stock price after a stock split. Since the corporation has not changed, total assets, liabilities, shareholders' equity will stay the exact same by the stock split. The change in the number of shares will trigger a real change in the market price of each share. For example, if a share had been trading at $50 before a 2-for-1 stock split, a share should be trading at $25 after the stock split. If the corporation had 100,000 shares of typical stock trading at $50 per share before a 2-for-1 stock split, the total market value of the shares would have been $5 million. After the 2-for-1 stock split, the corporation's market value will also be $5 million. 200,000 shares times $25 per share. That is the exact same for each financier. This is an example. The 10 shares owned by a small financier had a market value of $500. 10 shares times $50. After the 2-for-1 stock split, the small financier shares will also have a market price of $500. 20 shares times $25. Why stock splits occur? Stock divides like 2-for-1, 3-for-2, 4-for-1, and so forth, which increase the number of shares, are intended to reduce the marketplace price of each share of a corporation's common stock. Usually the purpose is to allow little investors to acquire 100 shares of the corporation's stock at a more sensible overall cost. Reverse stock divides like 1-for-10, which decrease the number of shares, are meant to increase the market price of each share of stock. Usually the purpose is to reduce the number of little investors. To illustrate, assume that a corporation had 800,000 shares of stock that were trading at $2 per share, leading to an overall market value of $1.6 million. Prior to the reverse stock split, small investors were able to purchase 100 shares for just $200. After the stock split, an investor will really need $2,000, 100 shares times $20, to buy 100 shares. What is a journal entry? Meaning of a journal entry. In manual accounting or bookkeeping systems, business transactions are first recorded in a journal, thus the term journal entry. Journal entries that are made a record of in a company's general journal will include the following: the proper date, the accounts and amounts that will be debited, the accounts and amounts that will be credited, a brief description /memo/reference. The journal entries appear in a journal in order by date and are then posted to the proper accounts in the general journal. Digital accounting systems will immediately make a record of the majority of the business transactions into the general journal accounts immediately after the software prepares the sales billings, problem checks to lenders, procedures receipts from consumers, etc. Thus, we won't write journal entries for the majority of the business deals. Examples of journal entries. Even with computerized accounting systems, some general journal entries are necessary. Common general journal entries are the changing entries. For instance, before providing the company's financial statements, there will be an adjusting entry to make a record of devaluation. That journal entry will debit devaluation expense and will credit accumulated depreciation. Another example of a basic journal entry is the adjusting entry to accumulate interest on a bank loan. That journal entry will debit interest expenditure and will credit interest payable. What are the journal entries for a stock split? Definition of a stock split. A stock split usually increases the number of shares of a corporation's typical stock with the objective of reducing the marketplace price of each share of stock. Example of a stock split. Presume that a corporation's typical stock has increased to $150 per share, and there are 100,000 shares provided and outstanding. The board of directors would like the shares of common stock to be trading near $50. To achieve this, the board approved a 3-for-1 stock split. After the stock split, there are 300,000 shares released and impressive. If an individual investor owned 10,000 shares or 10% of the 100,000 shares before the stock split, the stockholder will own 30,000 shares or 10% of the 300,000 shares after the stock split. What is the accounting journal entry for devaluation? Meaning of journal entry for depreciation. The journal entry for devaluation is debit to the salary statement account devaluation expense, credit to the balance sheet account accumulated devaluation. The salary declaration account depreciation cost is a momentary account. For this reason, at the end of each year, its balance is closed and the account depreciation cost will begin the next year with an absolutely no balance. The account accumulated devaluation is a balance sheet account, and thus its balance isn't closed at the end of the year. Accumulated depreciation is a contra asset account, whose credit balance will get larger each year, though its credit balance cannot go beyond the cost of the asset being depreciated. Purpose of journal entry for devaluation. The purpose of the journal entry for devaluation is to attain the matching concept. In each accounting period, part of the cost of certain assets, equipment, structure, vehicle, etc., will be moved from the balance sheet to depreciation cost on the salary statement. The objective is to match the cost of the property to the revenue earnings in the accounting periods in which the asset is being used. More info on the devaluation entry. It is essential to understand the following. The devaluation entry will trigger a decrease in the company's net income, but the company's cash is not reducing. Money was decreased when the property was gotten. The devaluation entry is a quote based upon the asset's historical cost, its estimated helpful life, and its approximated salvage value. The devaluation entry is an allotment of the possession's cost. It is not an attempt to show the current market value of the property. Chapter 4. What triggers a decrease in accumulated devaluation? The balance in the account accumulated depreciation will be decreased when an asset that has been depreciated is gotten rid of. When an asset is sold, the depreciation cost is first made a record of up to the date of the sale. Then the possession and its accumulated depreciation is removed and the earnings are noted. Here's an example. A business has equipment of $600,000 and accumulated depreciation of $380,000 before a product of equipment is sold. The original cost of the devices being sold was $50,000. The primary step is to make a record of the existing period's depreciation on that one item. Let's presume the depreciation will be $500. Let's also assume that after it is made a record of, the item's built-up devaluation will be $40,500. A debit to loss of disposal of asset for $4,500. A credit to equipment for $50,000. Prior to this deal, the balance in the accumulated devaluation account was a credit balance of $380,000. The property's current period devaluation of $500 increased the account's credit balance for $380,500. The disposal of the asset will reduce the balance in accumulated devaluation by $40,500 to a new balance of $340,000. What is the entry to remove equipment that's sold before it is totally depreciated? Entries to make a record of a sale of devices. When devices that is used in a firm is gotten rid of, sold, for cash, before it is fully diminished, 2 steps should be taken. Record the depreciation cost right up to the date of the disposal. Get rid of the device's cost and the up-to-date built-up devaluation, record the money received, and record the resulting gain or loss. The primary step needs a journal entry that debits depreciation expense for the depreciation up to the date of the disposal, credits accumulated depreciation for the depreciation up to the date of the disposal. The second step needs another journal entry to credit the account equipment to eliminate the equipment's cost, debit accumulated depreciation to get rid of the device's up-to-date collected devaluation, debit cash for the amount got. If a debit amount is needed because the money received was less than the equipment's book value, record a debit to loss on disposal of equipment. If a credit amount is needed because the cash received was greater than the equipment's book value, record a credit to gain on disposal of devices. If the equipment was traded in or exchanged for another property, the second step will be different. Chapter 5. What are retained earnings? Retained earnings is the amount of net income left over for the business after it's paid out all dividends to its shareholders. A business generates profits that can be positive profits or negative losses. Positive profits give a lot of room to the business owners or the company management to make use of the surplus money earned. Usually this profit is paid to shareholders, but it can also be reinvested back into the firm for development purposes. The cash not paid to investors counts as kept earnings. What retained profits tells you? Whenever a business produces surplus salary, a part of the long-term shareholders might expect some regular salary in the form of dividends as a reward for putting their money in the company. Traders who try to find short-term gains might also choose getting dividend payments that offer immediate gains. Dividends are also chosen as many jurisdictions enable dividends as tax-free income, while gains on stocks go through taxes. Meanwhile, company management might believe that they can better use the money if it is kept within the firm. Likewise, there might be investors who trust the management potential and might choose allowing them to keep the profits in hopes of much higher returns even with the taxes. Using retained earnings. The following options broadly cover all possibilities on how the surplus money can be utilized. The income money can be dispersed, completely or partially, among the business owners, shareholders, in the form of dividends. It can be invested to broaden the existing business operations, like increasing the production capacity of the existing products or hiring more sales agents. It can be invested to launch a new product/variant, like a fridge maker foraying into producing air conditioning units, or a chocolate cookie maker launching orange or pineapple flavored variations. The money can be utilized for any possible merger, acquisition, or partnership that leads to enhanced business prospects. It can also be used for share buybacks. The revenue can be used to repay any outstanding loan, financial debt the business might have. The first choice results in the income's cash going out of the books and accounts of the business forever because dividend payments are irreparable, though all of the other alternatives keep the earnings money for use within the business, and such investments and financing activities make up the retained earnings, RE. By definition, retained incomes are the cumulative net earnings or profits of a business after accounting for dividend payments. It's also called revenue surplus and represents the reserve cash which is available to the firm management for reinvesting back into the business. When uttered as a portion of overall earnings, it is also called retention ratio and is equal to 1 minus dividend payment ratio. While the last choice of debt repayment also results in the cash going out, it still has an effect on the business accounts, like saving future interest payments, which certifies it for inclusion in kept profits. Management and retaining earnings. The choice to retain the earnings or to disperse it amongst the shareholders is normally left to the firm management. Nonetheless, it can be challenged by the shareholders through bulk vote, as they are the real owners of the company. Management and shareholders may like the company to keep the revenues for some different reasons. Being better notified about the market and the firm's business, the management may have a high development task in view, which they might perceive as a prospect to generate significant returns in the future. In the long run, such initiatives might lead to better returns for the firm investors instead of that gained from dividend payments. Paying off high-interest debt is also preferred by both management and shareholders, rather than dividend payments. Most often, a well-balanced method is taken by the company's management. It includes paying a small amount of dividend and maintaining a great portion of the revenues, which offers a win-win. Dividends and retained earnings. Dividends can be dispersed in the form of cash or stock. Both forms of distribution lower maintained earnings. Money payment of dividend results in cash outflow and is made a record of in the books and accounts as net reductions. As the company loses ownership of its liquid assets in the form of cash dividends, it reduces the firm's property value in the balance sheet, therefore impacting RE. On the other hand, though stock dividend does not cause a cash outflow, the stock payment transfers a part of maintained incomes to typical stock. For instance, if a business pays 1 share as a dividend for each share held by the financiers, the price per share will reduce to half because the number of shares will essentially double. since the company has not created any real value simply by revealing a stock dividend. The per share market value gets changed in accordance with the percentage of the stock dividend. While the increase in the number of shares may not impact the company's balance sheet simply because the market price automatically gets adjusted, it decreases the per share assessment, which gets shown in capital accounts, thereby impacting the RE. A growth-focused firm might not pay dividends at all or pay extremely percentages, as it may choose to use the kept profits to finance activities like research and development, marketing, working capital requirements, capital investment, and acquisitions in order to accomplish additional growth. Such companies have high RE for many years. A maturing firm might not have many choices or high-return projects to use the surplus money, and it might prefer distributing dividends. Such companies have low RE. Retained earnings versus revenue streams. Both revenue and kept earnings are necessary in assessing a company's financial health, but they highlight different aspects of the financial picture. Revenue sits at the top of the income statement and is typically described as the top-line number when defining a firm's monetary performance. Since earnings is the total salary made by a business, it is the salary produced before running expenditures and overhead expenses are deducted. In some industries, revenue is called gross sales, since the gross figure is before any reductions. Retained earnings are the portion of a company's profit that is held or maintained and saved for future use. Retained earnings could be used for financing a growth or paying dividends to shareholders at a later date. Retained earnings are related to net instead of gross salary, since it's the net income amount saved by a company gradually. Limitations of retained earnings. As an analyst, the outright figure of retained incomes during a certain quarter or year may not offer any significant insight, and its observation over a time period, like over 5 years, might only suggest the trend about how much cash a company is maintaining. As an investor, one wishes to presume far more, like how much returns the kept earnings have created and if they were better than any alternative investments. Retained earning to market price. A way to assess how successful the firm was in making use of the maintained money is to look at an essential element called retained earnings to market price. It is determined over an amount of time, generally a number of years, and examines the change in stock cost against the net incomes retained by the company. For example, throughout the 5-year period between September 2013 and September 2017, Apple's stock price rose from $95.30 to $154.12 per share. During the exact same 5-year period, the total earnings per share were $38.87, while the overall dividend paid by the firm was $10 per share. Those figures are gotten to by summing up profits per share and dividend per share for each of the 5 years. These figures are readily available under the key ratio section of the company's reports. Chapter 6. Sinking Fund. What is a sinking fund? A sinking fund is a fund including money set aside or saved to settle a debt or bond. A company that issues financial debt will really need to pay that debt off in the future, and the sinking fund helps to soften the challenge of a big expense of revenue. A sinking fund is established so the company can contribute to the fund in the years leading up to the bond's maturity. A sinking fund explained. A sinking fund helps companies that have floated debt in the form bonds gradually save money and avoid a pretty big lump sum payment at maturity. Some bonds are provided with the attachment of a sinking fund function. The prospectus for a bond of this type will determine the dates that the provider has the alternative to redeem the bond early using the sinking fund. While the sinking fund helps companies guarantee they have enough funds reserved to settle their money debt, in many cases, they may also use the funds to repurchase preferred shares or exceptional bonds. Lower default risk. A sinking fund adds an aspect of safety to a business bond issue for financiers. Since there will be funds set aside to settle the bonds at maturity, there's less possibility of default on the money owed at maturity. To put it simply, the amount owed at maturity is significantly less if a sinking fund is established. As a result, a sinking fund helps investors have some protection in case of the company's insolvency or default. A sinking fund also helps a company allay issues of default risk, and because of that, attract more financiers for their bond issuance. Creditworthiness. Since a sinking fund adds an element of security and decreases default risk, the interest rates on the bonds are usually lower. As a result, the firm is usually seen as creditworthy, which can result in positive credit scores for its financial debt. Good credit rankings increase the need for a business's bonds for financiers, which is especially valuable if a business needs to release additional financial debt or bonds in the future. Financial impact. Lowering debt servicing costs as a result of lower rates of interest can enhance capital and success throughout the years. If the firm is carrying out well, financiers are more likely to purchase their bonds, causing increased demand and the probability the company could raise added capital if needed. Key takeaways. A sinking fund is an account containing cash reserved to pay off a debt or bond. Sinking funds might help settle the financial debt at maturity or assist in redeeming bonds on the free market. Callable bonds with sinking funds might be called back early, getting rid of future interest payments from the financier. Paying off debt early through a sinking fund saves a company interest cost and avoids the company from being put in financial troubles in the future. Callable bonds. If the bonds released are callable, it means the company can retire or pay off a portion of the bonds early, using the sinking fund when it makes financial sense. The bonds are embedded with a call option, giving the issuer the right to call or buy back the bonds. The prospectus of the bond issue can supply details of the callable feature, consisting of the timing in which the bonds can be called, particular cost levels, and also the number of bonds that are callable. Generally, only a part of the bonds released are callable, and the callable bonds are chosen by random using their serial numbers. A callable is usually called at a quantity somewhat above par value, and those called earlier have a greater call value. An example would be the following. A bond callable at a price of $102 pays the financier $1,020 for each $1,000 in face value. Yet stipulations might specify that the cost goes down to $101 after a year. If rates of interest decline after the bond's problem, the company can issue new financial debt at a lower interest rate than the callable bond. The firm uses the profits from the second problem to settle the callable bonds by exercising the call feature. As a result, the firm has refinanced its debt by paying off the higher-yielding callable bonds with a newly issued financial debt at a lower rate of interest. Also, if interest rates decrease, which would result in higher bond rates, the face value of the bonds would be lower than existing market value. In this case, the bonds could be called by the company who redeems the bonds from investors at stated value. The financiers would lose some of their interest payments, resulting in less long-lasting income. Other kinds of sinking funds. Sinking funds may be used to redeem preferred stock. Preferred stock typically pays a more attractive dividend than common equity shares. A business could reserve cash deposits to be used as a sinking fund to retire favored stock. Sometimes, the stock can have a call alternative attached to it, indicating the firm can redeem the stock at a fixed price. Business accounting of sinking funds. A sinking fund is normally listed as a non-current property or long-lasting asset on a business's balance sheet and is typically included in the listing for long-term financial investments or other investments. Companies that are capital extensive typically provide long-lasting bonds to money purchases of new plant and equipment. Oil and gas firms are capital intensive because they require a substantial amount of capital or money to fund long-lasting operations like oil rigs and drilling equipment. Real-life example of a sinking fund. Let's say, for example, that ExxonMobil Corp., XOM, released US $20 billion in long-lasting financial debt in the form of bonds. Interest payments were to be paid semi-annually to bondholders. The firm established a sinking fund whereby $4 billion must be paid to the fund year after year to be used to pay for debt. By year 3, Exxon had paid off $12 billion of the $20 billion in long-term debt. The firm could have opted not to establish a sinking fund, but it would have had to pay out $20 billion from profit, cash, or retained revenues in year 5 to pay off the debt. The firm would have also needed to pay 5 years of interest payments on all of the debt. If economic conditions had weakened or the cost of oil collapsed, Exxon may have had a cash deficiency as a result of lower earnings and not been able to meet its debt payment. Paying the money debt early through a sinking fund saves a business interest expense and prevents the company from being put in monetary troubles in the long-lasting if economic or financial conditions aggravate. Besides, the sinking fund allows Exxon the alternative to obtain more cash if needed. In our example above, let's say by year 3, the company needed to release another bond for added capital. Since only $8 billion of the $20 billion in original money debt remains, it would likely have the ability to obtain more capital since the company has had such a solid track record of settling its debt early. Chapter 7. Solvency. What is solvency? Solvency is the capability of a company to meet its long-lasting financial obligations and financial commitments. Solvency can be an essential measure of financial health, since it's one way of showing a business's ability to manage its operations into the foreseeable future. The quickest way to examine a business's solvency is by checking its investors' equity on the balance sheet, which is the amount of a business's assets minus liabilities. How solvency functions. Solvency portrays the capability of a company or individual to benefit its monetary obligations. For this reason, the quickest assessment of a company's solvency is its assets minus liabilities, which equal to its investors' equity. There are also solvency ratios, which can highlight certain parts of solvency for deeper analysis. Many companies have negative investors' equity, which signifies insolvency. Negative investors' equity insinuates that a company has no book value, and this could even result in personal losses for small company owners if not secured by limited liability terms if a company must close. In essence, if a company was needed to immediately close down, it would need to liquidate all of its assets and pay off all of its liabilities, leaving only the shareholders' equity as a remaining value. The investor's equity on a company's balance sheet can be a fast way to check a business's solvency and monetary health. Carrying negative investors' equity on the balance sheet is usually only typical for freshly developing personal firms, startups, or recently offered public firms. As a business grows, its solvency position usually improves. Still, certain events may create an increased risk to solvency, even for well-established firms. When it comes to business, the pending expiration of a patent can pose threats to solvency, as it will allow rivals to produce the item in question, and it leads to a loss of associated royalty payments. Further, changes in certain guidelines that directly affect a company's capability to continue business operations can pose an additional risk. Both organizations and individuals may also experience solvency concerns should a big judgment be ordered against them after a suit. When examining solvency, it is also important to be aware of certain procedures used for handling liquidity. Solvency and liquidity are two different things, but it is often wise to evaluate them together, particularly when a company is insolvent. A business can be insolvent and still produce routine cash flow and also consistent levels of working capital. Special considerations: solvency ratios. Assets minus liabilities is the quickest way to examine a firm's solvency. The solvency ratio calculates net income plus devaluation and amortization divided by total liabilities. That ratio is typically used first when building out the solvency analysis. There are also other ratios that can help to more deeply examine a business's solvency. The interest coverage ratio divides running income by interest expense to show a business's capability to pay the interest on its financial debt. A higher interest coverage ratio indicates greater solvency. The debt-to-assets ratio divides a company's money debt by the value of its assets to supply signs of capital structure and solvency health. Other ratios that might be analyzed when considering solvency include debt to equity, financial debt to capital, debt to tangible net worth, total liabilities to equity, overall assets to equity, money debt to EBITDA. Solvency ratio levels vary by industry, so it is essential to understand what constitutes a really good ratio for the company before reasoning from the ratio calculations. Ratios that suggest lower solvency than the industry average could raise a flag or suggest financial issues on the horizon. Solvency versus liquidity. While solvency represents a firm's ability to meet all of its financial commitments, generally the amount of its liabilities, liquidity represents a company's ability to meet its short-term obligations. That's why it can be particularly crucial to check a company's liquidity levels if it has an unfavorable book value. One of the most convenient and quickest ways to look at liquidity is by deducting short-term assets minus short-term liabilities. That is also the estimation for working capital, which shows how much cash a company has readily offered to pay its upcoming costs. Short-term assets and short-term liabilities are those that have a 1-year time span. An example would be the following. Money and its equivalents is a common short-term asset. Short-term accounts payable is a typical short-term liability. A business can endure with insolvency for a sensible time period, but a business cannot make it through without liquidity. Some intriguing ratios that can be handy in more deeply evaluating liquidity can include quick ratio, present ratio, operating capital turnover. Chapter 8. Subordinated Financial Obligation Meaning. What is subordinated debt? Subordinated money debt, also known as subordinated debenture, is an unsecured loan or bond that ranks beneath another, more senior loan or security with respect to claims on assets or incomes. Subordinated debentures are hence also referred to as junior securities. In the case of debtor default, lenders who own subordinated debt won't be paid till after senior shareholders are paid completely. Comprehending subordinated financial obligation. Subordinated money debt is riskier than unsubordinated financial debt. Subordinated money debt is any type of loan that is paid after other corporate financial obligations and loans are repaid in the case of customer default. Borrowers of subordinated financial debt are typically bigger corporations or other business entities. Subordinated debt is the exact opposite of unsubordinated debt in that senior debt is prioritized higher in insolvency or default circumstances. Subordinated debt repayment mechanics. When a corporation takes out money debt, it generally provides two or more bond types that are either unsubordinated financial debt or subordinated money debt. If the company defaults and declares insolvency, a bankruptcy court will focus on loan payments and needs that the business repay its exceptional loans with its assets. The financial debt that's considered lower in concern is the subordinated debt. The higher priority debt is considered unsubordinated debt. The insolvent company's liquidated assets will first be used to pay the unsubordinated money debt. Any money in excess of the unsubordinated debt will then be designated to the subordinated debt. Holders of subordinated money debt will be fully repaid if there is definitely enough cash on hand for repayment. It's also possible that subordinated debt holders will receive either a deposit or no payment at all. Since subordinated financial debt is dangerous, it is essential for potential lending institutions to be mindful of a business's solvency, other money debt commitments, and total assets when examining a released bond. Though subordinated debt is riskier for loan companies, it's still paid prior to any equity holders. Bondholders of subordinated debt are also able to understand a greater interest rate to make up for the potential risk of default. While subordinated debt is issued by a range of organizations, its usage in the banking market has gotten unique attention. Such financial debt is appealing for banks because interest payments are tax deductible. A 1999 study by the Federal Reserve advised that banks issue subordinated money debt to self-discipline their risk levels. The research study's authors reasoned that issuance of debt by banks would need profiling of risk levels, which, in turn, would offer a window into a bank's finances and operations throughout a time of considerable change after a repeal of the Glass-Steagall Act. In some circumstances, subordinated debt is being used by shared cost savings banks to buffer up their balance to meet regulatory requirements for Tier 2 capital. Subordinated financial obligation, reporting for corporations. Subordinated money debt, like all other money debt obligations, is considered a liability on a company's balance sheet. Present liabilities are listed first on the balance sheet. Senior financial debt, or unsubordinated debt, is then listed as a long-term liability. Finally, subordinated debt is noted on the balance sheet as a long-term liability in order of payment concern, underneath any unsubordinated financial debt. When a company concerns subordinated debt and receives cash from a lending institution, its money account or its property, plant and devices (PPE) account, boosts, and a liability is made a record of for the exact same amount. Subordinated debt versus senior debt. An overview. The distinction between subordinated financial debt and senior financial debt is the concern in which the money debt claims are paid by a firm in bankruptcy or liquidation. If a business has both subordinated debt and senior debt and has to file for bankruptcy or face liquidation, the senior money debt is paid back before the subordinated financial debt. Once the senior debt is completely repaid, the firm then repays the subordinated debt. Senior money debt has the greatest priority, and for that reason the most affordable risk. Thus, this type of money debt normally brings or offers lower rates of interest. In the meantime, subordinated debt brings higher interest rates, given its lower concern during vengeance. Senior debt is typically financed by banks. The banks take the lower risk senior status in the payment order because they can generally afford to accept a lower rate given their low-cost source of financing from deposit and cost savings accounts. Additionally, regulators advocate for banks to maintain a lower risk loan portfolio. Subordinated debt is any debt that falls under or behind senior financial debt, though subordinated debt does have priority over preferred and common equity. Examples of subordinated financial debt include mezzanine debt, which is debt that also includes a financial investment. In addition, asset-backed securities usually have a subordinated function, where some tranches are considered subordinate to senior tranches. Asset-backed securities are financial securities collateralized by a pool of assets consisting of loans, leases, charge card debt, royalties, and receivables. Tranches are portions of debt or securities that have been developed to divide risk or group attributes so that they can be marketable to different financiers. Chapter 9. Financial Risk versus Business Risk. Financial risk versus business risk. A summary. Financial risk and business risk are two different kinds of signs that financiers should examine when considering making an investment. Monetary risk refers to a firm's capability to manage its debt and financial leverage, while business risk describes the firm's ability to generate enough revenue to cover its operational costs. An alternate way of seeing the difference is to look at monetary risk as the risk that a company may default on its debt payments, and business risk as the risk that the company will be not able to function as a successful enterprise. Financial risk. A business's financial risk is related to the firm's usage of monetary leverage and debt financing, rather than the operational risk of making the company a rewarding business. Financial risk is interested in a firm's capability to create adequate capital to be able to make interest payments on financing or meet other debt-related responsibilities. A business with a reasonably higher level of debt financing brings a higher level of financial risk, since there's a greater possibility of the company not having the ability to meet its financial responsibilities and being insolvent. Some of the elements that may affect a firm's financial risk are rates of interest changes and the general percentage of its money debt financing. Companies with greater amounts of equity funding are in a better position to manage their debt burden. One of the main financial risk ratios that experts and financiers consider to figure out a business's financial stability is the debt-to-equity ratio, which gauges the relative percentage of debt and equity funding. Debt-to-equity ratio equals total liabilities divided by shareholders' equity. Foreign currency exchange rate risk is a part of the overall monetary risk for businesses that do a considerable amount of business in foreign countries. Business risk. Business risk describes the standard practicality of a business, the question of whether a business will be able to make enough sales and produce adequate revenues to cover its functional expenses and make a profit. While financial risk is worried about the cost of financing, business risk is interested in all the other expenses a business must cover to stay operational and functioning. Those expenses include wages, production expenses, center rent, and office and administrative expenditures. The level of a firm's business risk is affected by factors like the cost of items, profit margins, competition, and the general level of demand for the services or products that it sells. Special considerations. Business risk is often categorized into methodical risk and unsystematic risk. Organized risk refers to the general level of risk associated with any business enterprise, the standard risk arising from varying financial, political, and market conditions. Methodical risk is an inherent business risk that companies generally have little control over, other than their ability to prepare for and respond to changing conditions. Unsystematic risk, however, describes the threats connected to a particular business in which a company is engaged. A business can lower its level of unsystematic risk through good management decisions regarding costs, expenses, financial investments, and marketing. Operating leverage and free capital are metrics that investors use to evaluate a business's functional efficiency and management of funds. Chapter 10. Debt Restructuring. What is debt restructuring? Money debt restructuring is a process used by businesses to avoid the risk of default on existing financial debt, or to make the most of lower readily available interest rates. Money debt restructuring can be performed by people on the brink of insolvency too, and by nations that are heading for default on sovereign debt. How financial obligation restructuring works. Some companies seek to reorganize debts when they're facing personal bankruptcy. They might have several loans are structured in such a way that some are secondary in concern to other loans. The senior debt holders would be paid before the lending institutions of subordinated debts if the firm were to get into insolvency. Financial institutions are sometimes willing to modify these and other terms to keep away from dealing with a potential insolvency or default. The debt restructuring process is normally carried out by minimizing the rates of interest on loans, by extending the dates when the firm's liabilities are to be paid, or both. Those steps improve the firm's chances of paying back the commitments. Financial institutions comprehend that they would get even less should the company be pushed into insolvency and/or liquidation. Restructuring money debt can be a win-win for both entities. The business keeps away from insolvency, and the lenders generally receive more than what they would through a personal bankruptcy case. Individuals can restructure their financial obligations in various ways too, but be sure to check the qualifications and credibility of any financial debt relief service you're thinking about with your state's Attorney General of the United States or customer defense company, because not all are respectable. Kinds of debt restructuring. A debt restructure may also include a debt for equity swap. This occurs when financial institutions accept, cancel a part or all of their arranges in exchange for equity in the firm. The swap is typically a favorite option when the money debt and assets in the company are extremely considerable, so requiring it into personal bankruptcy wouldn't be ideal. The financial institutions would rather take control of the distressed company as a going concern. A business trying to reorganize its debt may also renegotiate with its shareholders to take a hairstyle, where a part of the outstanding interest payments would be crossed out, or a portion of the principal would not be paid back. A company will typically provide callable bonds to protect itself from a scenario in which interest payments can't be made. A bond with a callable function can be redeemed early by the company in times of reducing interest rates. This allows the company to readily restructure financial debt in the future because the existing money debt can be changed with new debt at a lower rate of interest. Other examples of debt restructuring. Individuals dealing with insolvency can renegotiate terms with financial institutions and tax authorities. For example, an individual who is unable to keep making payments on a $250,000 subprime mortgage may agree with a lending institution to decrease the mortgage to 75%, or $187,500. 75% times $250,000 equals $187,500. In return, the lender might receive 40% of the earnings of the house sale when it's sold by the debtor. Countries can face default on their sovereign foreign debt, and this has been the case throughout history. In modern-day times, they sometimes choose to restructure their debt with shareholders. This can mean moving the financial debt from the private sector to public sector organizations that may be better able to manage the effect of a nation default. Sovereign bondholders might also have to take a haircut by consenting to accept a minimized portion of the money debt, maybe 25% of the full value of the bond. The maturity dates on bonds can also be extended, giving the government company more time to secure the funds needed to repay its shareholders. Sadly, this kind of money debt restructuring doesn't have much in the way worldwide oversight, even when reorganizing efforts cross borders. Debt restructuring provides a less costly alternative to bankruptcy when a business, individual, or country is in monetary chaos. It's a procedure through which an entity can receive financial debt forgiveness and money debt rescheduling to keep away from foreclosure or liquidation of assets. This has been Accounting, Dividends, Debt, and Financial Risks Explained by Gerard Howells. Narrated by Wes Grant. Copyright 2020 by Gerard Howells. Production copyright by Gerard Howells. Accounting. How to calculate rollover risks, credits, leasebacks, and other financial variables. Written by Gerard Howells. Narrated by Wes Grant. Chapter 1. Netting. What is netting? Netting involves offsetting the value of multiple positions or payments due to be exchanged between two or more parties. It can be used to determine which party is owed reimbursement in a multi-party agreement. Netting is a general concept that has certain more specific, figured out, including in the monetary markets. How netting works. Netting is a technique of reducing risks in financial agreements by combining or aggregating multiple financial commitments to come to a net responsibility amount. Netting is used to decrease settlement, credit, and other financial threats between two or more parties. Netting is typically used in trading, where a financier can balance out a position in one security or currency with another position either in the same security or a different one. The objective of netting is to balance out losses in one position with gains in another. This is an example. If a financier is brief 40 shares of a security and long 100 shares of the exact same security, the position is net long 60 shares. Netting is also used when a business applies for insolvency, whereby the parties tend to net the balances owed to each other. That is also called a set-off stipulation or set-off law. In other words, a business working with a defaulting firm might balance out any cash they owe the defaulting firm with cash that is owed them. The remainder represents the total amount owed by them or to them, which can be used in insolvency proceedings. Companies can also use netting to simplify third-party invoices, eventually lowering several billings into a single one. An example would be the following. Some divisions in a pretty big transport corporations purchase paper supplies from a single supplier, but the paper supplier also uses the same transport company to ship its items to others. By netting how much each party owes the other, A single invoice can be created for the company that has the outstanding expense. This method can also be used when moving funds between subsidiaries. Netting saves a good deal of time by removing the need to process several transactions, minimizing the number of transactions down to one. Types of netting. Here are the leading 4 ways netting is used. Closeout netting. Closeout netting happens after default, which is when a party fails to make principal and interest payments. Transactions between the two parties are netted to get to a single amount for one party to pay the other. In closeout netting, the existing contracts are terminated, and an aggregate terminal value is calculated and paid as one swelling amount. Settlement netting, also referred to as payment netting. Settlement netting aggregates the amount due among parties and nets the cash streams into one payment. Simply put, only the net difference in the aggregate quantities is provided or exchanged by the party with the net owed commitment. Normally, a payment netting contract must be in place before the settlement date. Otherwise, each of the individual payments would be because of and from all parties included. Netting by novation. Novation netting cancels offsetting swaps and replaces them with new commitments. To put it simply, if two firms have responsibilities due to one another on the same value date or settlement date, the net amount is calculated. Yet, instead of simply sending out the net difference to the party owed, novation netting cancels the contracts and books a new one for the net or aggregate amount. The new aggregate agreement under novation netting makes it definitely different from payment netting, which doesn't schedule a new contract. Instead, the net aggregate amount is exchanged. Multilateral netting. Multilateral netting is netting that involves more than two parties. In this case, a clearinghouse or main exchange is typically used. Multilateral netting can also occur within one firm with multiple subsidiaries. If the subs owe payments to one another for different quantities, they can each send their payments to a main corporate entity or netting center. The primary office would net the invoices in the different currencies from the subsidiaries and make the net payment to the parties that are owed. Multilateral netting involves pooling the funds from two or more parties so that a more streamlined invoicing and payment process can be achieved. Benefits of netting. Netting saves businesses a good deal of time and costs by removing the need to process a ton of transactions monthly and minimizing the deals necessary to one payment. For banks moving across borders, it restricts the number of Forex deals as the number of circulations reduces. With netting in Forex, firms or banks can combine the number of currencies and Forex offers into bigger trades, profiting of improved pricing. When businesses have more organized amounts of time and predictability in settlements, they can more properly anticipate their cash flows. Example of netting. Netting is really common in the swap markets. An example would be the following. Presume two parties enter into a swap agreement on a specific security whereby they both owe money to one another. At the end of the swap period, the following is due. Investor A is due to get $100,000 from Investor B. Financier B is due to get $25,000 from Investor A. Rather than Financier B paying Financier A $100,000 and Financier A providing Financier B $25,000, the payments would be netted. Financier A would give Investor B $0, while Financier B would give Financier A $75,000. This netting process takes place on a wide variety of swaps, but there is one type of swap where netting does not happen. With currency swaps, since the notional quantities are in different currencies, the notional amounts are exchanged in their respective currencies, and all payments due are exchanged completely between two parties. No netting occurs. Chapter 2. Advance Payment. What is an advanced payment? Advance payment is a type of payment made ahead of its regular schedule, such as paying for a good or service before you actually get it. Advance payments are sometimes required by sellers as security against non-payment, or to cover the seller's out-of-pocket expenses for supplying the product or service. There are a lot of cases where advance payments are required. Customers with bad credit might be required to pay firms ahead of time. An insurance provider normally need an advance payment so as to extend coverage to the insured party. Comprehending advance payments. Advance payments are amounts paid before a good or service is actually received. The balance that's owed, if any, is paid once delivery is made. These types of payments are in contrast to delayed payments, or payments in arrears. In these cases, items or services are provided first, then paid for later. This is an example: a worker who is paid at the end of every month for that month's work. Advance payments are recorded as assets on a business's balance sheet. As these assets are used, they're used up and recorded on the income statement for the period in which they are incurred. Advance payments are usually made in two situations. They are either applied to an amount of cash provided before a contractually agreed upon due date, or they might be needed before the invoice of the asked for products or services. Examples of advance payments. There are many examples of advance payments in the real life. Take prepaid cell phones, for instance. Companies require payment for cell services that will be used by the customer 1 month ahead of time. If the advance payment isn't received, the service will not be provided. The same definitely applies to payments for upcoming rent or energies before they are contractually due. Another example definitely applies to qualified U.S. taxpayers who received advance payments through the Premium Tax Credit, PTC, offered as part of the Affordable Care Act, ACA. The monetary help as a result of the taxpayer is provided to the selected insurance company in advance of the real due date for the credit. Customers with bad credit might also be required to provide lenders with advance payments before they can purchase goods or services. Federal governments also provide advance payments to taxpayers, like Social Security. Special considerations: advance payments to providers. In the business world, companies often need to make advance payments to providers when their orders are big enough to be challenging to the producer. That is especially true if the purchaser chooses to revoke the offer before delivery. Advance payments can help manufacturers who do not have enough capital to buy the materials to satisfy a huge order, as they can use part of the money to pay for the product they will be creating. It can also be used as a guarantee that a specific amount of revenue will be brought in by producing the big order. If a corporation is required to make an advance payment, it is noted as a prepaid expenditure on the balance sheet under the accrual accounting method. Advance payment assurances. An advance payment warranty acts as a form of insurance, ensuring the purchaser that must the seller fail to meet the agreed-upon commitment of items or services, the advance payment amount will be refunded to the buyer. That security permits the purchaser to consider a contract void if the seller fails to perform, declaring the purchaser's rights to the preliminary funds paid. Chapter 3. Liquidation Preference. What is a liquidation preference? A liquidation preference is a stipulation in an agreement that dictates the payment order in case of a business liquidation. Typically, the firm's financiers or chosen stockholders get their refund first, ahead of any other kind of stockholders or debt holders, on the occasion that the company should be liquidated. Liquidation preferences are regularly used in equity capital agreements to clarify what investors earn money and in which order in a liquidation event, such as the sale of the company. Comprehending liquidation preference. Liquidation preference, in its broadest sense, determines who gets how much when a business is liquidated, sold, or goes bankrupt. To come to this conclusion, the company's liquidator must analyze the company's protected and unsecured loan agreements, and also the meaning of the share capital, both preferred and common stock, in the firm's short articles of association. Because of this process, the liquidator is then able to rank all lenders and investors and disperse funds accordingly. How liquidation preferences work. The application of particular liquidation preference dispositions is well known when equity capital firms invest in startup businesses. The financiers often make it a condition for their investment that they get liquidation preference over other shareholders. This secures investors from losing money by making sure they get their preliminary investments back before other parties. In these cases, there doesn't really need to be a real liquidation or insolvency of a company. In venture capital contracts, a sale of the firm is usually considered to be a liquidation event. As such, if the company is sold at a profit, liquidation preference can also help venture capitalists be initially in line to claim part of the profits. Venture capitalists are typically repaid before holders of typical stock and before the firm's original owners and staff members. In most cases, the venture capital firm is also a common investor. Liquidation preference examples. For instance, assume an equity capital company invests $1 million in a startup in exchange for 50% of the common stock and $500,000 of favored stock with liquidation preference. Assume also that the creators of the company invest $500,000 for the other 50% of the typical stock. If the firm is then sold for $3 million, the venture capital investors receive $2 million, being their preferred $1 million and 50% of the rest, while the creators get $1 million. Alternatively, if the company sells for $1 million, the venture capital firm gets $1 million and the founders receive nothing. More generally, liquidation preference can also describe the payment of financial institutions, such as shareholders, before shareholders if a company declares bankruptcy. In such a case, the liquidator sells its assets, then uses that cash to repay senior lenders first, then junior creditors, then investors. In the same way, lenders holding liens on particular assets, such as a home loan on a structure, have a liquidation preference over other creditors concerning the profits of sale from the structure. Chapter 4. Credit Analysis. What is credit analysis? Credit analysis is a type of analysis a financier or bond portfolio manager performs on businesses or other debt-releasing entities to gauge the entity's capability to meet its debt commitments. The credit analysis seeks to recognize the appropriate level of default risk associated with investing in that specific entity. How credit analysis works. To judge a company's ability to pay its debt, banks, bond financiers, and experts conduct a credit analysis on the company. Using monetary ratios, capital analysis, pattern analysis, and monetary projections, an expert can evaluate a company's capability to pay its responsibilities. An evaluation of credit history and any collateral is also used to determine the credit reliability of a company. Not only is the credit analysis used to predict the likelihood of a borrower defaulting on its debt, but it's also used to assess how severe the losses will be in the event of default. The outcome of the credit analysis will decide on which danger rating to appoint the debt company or customer. The risk ranking, in turn, figures out whether to extend credit or loan money to the borrowing entity and, if so, the amount to lend. Credit analysis example. An example of a financial ratio used in credit analysis is the debt service coverage ratio, DSCR. The DSCR is a procedure of the level of capital readily available to pay present debt obligations, such as interest, principal, and lease payments. A debt service coverage ratio beneath 1 shows an unfavorable cash flow. For instance, a financial obligation service coverage ratio of 0.89 suggests that the firm's net operating salary is more than enough to cover only 89% of its annual financial debt payments. Other than basic elements used in credit analysis, ecological factors such as regulative environment, competitors, taxation, and globalization can also be used in combination with the basics to reflect a debtor's capability to repay its financial obligations relative to other borrowers in the market. Unique considerations. Credit analysis is also used to approximate if the credit ranking of a bond issuer is about to change. By identifying firms that are about to experience a change in financial debt rating, an investor or manager can speculate on that change and potentially earn a profit. For example, presume a manager is considering purchasing scrap bonds in a business. If the supervisor really believes that the firm's debt ranking is about to enhance, which is a signal of fairly lower default risk, then the manager can purchase the bond before the rating change takes place, and after that, sell the bond after the change in rating at a higher price. Chapter 5. Rollover Risk. What is rollover risk? Rollover risk is a threat associated with the refinancing of financial debt. Rollover risk is commonly dealt with by nations and firms when a loan or other debt responsibility, like a bond, is about to grow and needs to be transformed or rolled over into new debt. If rates of interest have risen in the meantime, they would have to refinance their debt at a higher rate and incur more interest charges in the future, or, in case of a bond issue, pay out more in interest. How rollover risk works. Rollover risk also exists in derivatives, where futures or options agreements must be rolled over to later maturities as near-term agreements expire, so as to maintain one's market position. If this process will incur an expense or lose money, it positions a risk. In particular, it refers to the possibility that a hedge position will expire at a loss, requiring a cash payment when the ending hedge is replaced with a new one. In other words, if a trader wants to hold a futures agreement until its maturity and then replace it with a new, similar agreement, they run the risk of the new contract costing more than the old, paying a premium to extend the position. Rollover risk versus refinancing risk, also referred to as roll risk. Rollover risk is in some cases used interchangeably with refinancing risk. However, it is actually more of a subcategory of that. Refinancing risk is a more general term describing the possibility of a borrower not being able to replace an existing loan with a new one. Rollover risk deals more specifically with the negative influence of rolling over or refinancing debt. This effect has more to do with prevailing financial conditions, particularly rate of interest trends and the liquidity of credit, than the monetary condition of the borrower. An example would be the following. If the U.S. had $1 trillion of debt, it needed to roll over in the next year, and rates of interest all of a sudden rose 2% higher before the new financial debt was provided. It would cost the government more in new interest payments. The state of the economy is also substantial. Lenders are often unwilling to restore expiring loans during a financial crisis when security values drop, specifically if they are short-range loans, that is, their remaining maturity is less than 1 year. So, in addition to the economy, the nature of the money debt can matter, according to a 2012 article, Rollover Risk and Credit Risk, published in the Journal of Finance. Debt maturity plays an important role in figuring out the firm's rollover risk, while much shorter maturity for an individual bond decreases its risk. Shorter maturity for all bonds issued by a company intensifies its rollover risk by requiring its equity holders to quickly take in losses incurred by its money debt financing. Example of rollover risk. At the beginning of October 2018, the World Bank released concerns about two Asian nations. Rollover threats are potentially acute for Indonesia and Thailand, given their substantial stocks of short-range debt, around $50 billion and $63 billion, respectively, it specified. The World Bank's concerns reflected the fact that central banks around the world have been tightening up credit and raising interest rates, following the lead of the United States Federal Reserve, which has increased the federal funds rate progressively since 2015, from near 0% to 2.25% in December 2018, leading to billions in USA and foreign financial investments being pulled from both countries. Chapter 6. Leaseback. What is a leaseback? A leaseback is a plan in which the company that sells an asset can rent back that exact same property from the purchaser. With a leaseback, also called a sale leaseback, the details of the plan, such as the lease payments and lease period, are made immediately after the sale of the possession. In a sale leaseback transaction, the seller of the asset becomes the lessee, and the purchaser ends up becoming the lessor. Comprehending leasebacks. In sale leaseback agreements, an asset that's previously owned by the seller is sold to somebody else and then leased back to the first owner for a long period of time. In this way, a company owner can continue to use an essential property, but ceases to own it. Another mindset of a leaseback is like a corporate version of a pawn shop deal. A company goes to the pawn shop with an important asset and exchanges it for a fresh infusion of money. The difference would be that there is no expectancy that the firm would redeem the property. Who uses leasebacks and why? The most typical users of sale leasebacks are home builders or businesses with high-cost set assets like property, land, or big expensive equipment. As such, leasebacks are really common in the structure and transportation markets, and the property and aerospace sectors. Firms use leasebacks when they really need to make use of the money they invested in an asset for other purposes, but they still really need the property itself to operate their business. Sale leasebacks can be appealing as alternative approaches of raising capital. When a business needs to raise money, it usually is taking out a loan, incurring debt, or affects an equity financing, providing stock. A loan has to be paid back and appears on the firm's balance sheet as a financial obligation. A leaseback deal can actually help improve a firm's balance sheet health. The liability on the balance sheet will decrease by keeping away from more financial debt, and present assets will show a boost in the form of cash and the lease agreement. Although equity does not need to be paid back, shareholders have a claim on a business's earnings based on their part of its stock. A sale leaseback is neither debt nor equity funding. It's more like a hybrid financial debt product. With a leaseback, a business does not increase its financial debt load, but rather accesses to needed capital through the sale of assets. Example of a leaseback. There are many examples of sale leasebacks in business financing. However, a typical, easy-to-understand example lies in the safe deposit vaults that commercial banks give us to store our belongings. At the beginning, a bank owns all of the physical vaults in its basements. The bank sells the vaults to a renting company at market price, which is considerably higher than the book value. Consequently, the leasing firm will offer back these vaults to the exact same banks to rent on a long-term basis. The banks, in turn, sublease these vaults to us, its customers. More advantages of leasebacks. Sale-leaseback transactions may be structured in various ways in which can benefit both the seller, lessee, and the buyer, lessor. Having said that, all parties must consider the business and tax ramifications, as well as the dangers associated with this type of plan. Potential advantages to seller, lessee. Can provide added tax reductions. Allows a company to broaden its business. Can help to enhance the balance sheet. Limitations, volatility threats of owning the asset. Potential benefits to buyer/lessor. Insured lease. A fair return on investment, ROI. Steady salary stream for a defined time. Chapter 7. Gearing. What is gearing? Gearing refers to the relationship or ratio of a company's debt to equity, D to E. Gearing shows the level to which a firm's operations are subsidized by loan institutions versus investors. In other words, it measures a company's monetary leverage. When the proportion of debt to equity is great, then a company might be considered being highly tailored or highly leveraged. Understanding gearing. Gearing is measured by some ratios, consisting of the D to E ratio, shareholders' equity ratio, and debt service coverage ratio, DSCR, which show the level of risk related to a certain business. The appropriate level of gearing for a business depends on its sector and the degree of leverage of its corporate peers. For instance, a gearing ratio of 70% shows that a company's debt levels are 70% of its equity. A tailoring ratio of 70% might be really workable for an utility firm, as the business functions as a monopoly with support from city government channels, but it may be extreme for a technology company with extreme competition in a quickly changing market. Special factors to consider. Gearing or leverage helps to identify a company's creditworthiness. Lenders may consider a company's gearing ratio when deciding whether to extend it credit, to which a loan provider may add elements like if the loan would be supported with collateral and if the lending institution would qualify as a senior lending institution. With this info, senior loan institutions might choose to remove short-term money debt responsibilities when computing the gearing ratio, as senior loan services get top priority in the event of a business's personal bankruptcy. In cases where a lending institution would be offering an unsecured loan, the gearing ratio would include info about the presence of senior loan providers and chosen investors who have certain payment guarantees. This permits the lender to change the estimation to reflect a higher level of risk than would exist with a secured loan. Gearing versus risk. In general, a business with excessive leverage, demonstrated by its high gearing ratio, could be more susceptible to financial downturns than a company that's not as leveraged, just because a highly leveraged firm must make interest payments and service its debt by means of cash flows, which could decline throughout a decline. On the other hand, the risk of being highly leveraged works well during good economic times, as all of the excess money streams accumulate to shareholders once the debt has been paid for. Example of gearing. As a basic illustration, to money its expansion, XYZ Corporation cannot sell additional shares to financiers at a reasonable price. So instead, it acquires a $10 million short-range loan. Presently, XYZ Corporation has $2 million of equity, So the D to E ratio, debt to equity, is 5 times. Chapter 8. Lien. What is a lien? A lien is a claim or legal right against assets that are typically used as collateral or security to please a debt. A lien could be developed by a lender or a legal judgment. A lien serves to guarantee an underlying commitment, like the repayment of a loan. If the hidden obligation isn't satisfied, the lender might be able to take the possession that's the topic of the lien. There are many types of liens that are used to secure assets. How liens work. A lien provides a lender with the legal right to take and sell the collateral property or asset of a debtor who fails to meet the obligations of a loan or agreement. The property that is the topic of a lien can't be sold by the owner without the approval of the lien holder. A floating lien refers to a lien on inventory or other unfixed property. Liens can be voluntary or consensual, like a lien on a property for a loan. Having said that, there are also uncontrolled or statutory liens whereby a lender seeks legal action for non-payment, and because of that, a lien is placed on assets including property and savings accounts. Some liens are filed with the federal government to let the public know that the lien holder has an interest on the property or property. A lien's public record tells anyone interested in acquiring the asset or collateral that the lien should be released before the asset can be sold. Types of liens. There are many kinds of liens and lien holders. Liens can be put in place by banks, federal governments, and small companies. Below are some of the most typical liens. Bank lien. A lien is usually granted when an individual is taking out a loan from a bank to purchase an asset. For instance, if an individual purchases a car, the seller would be paid using the borrowed funds from the bank. Consequently, the bank would be given a lien on the vehicle. If the customer does not pay back the loan, the bank may execute the lien, seize the lorry, and sell it to repay the loan. If the customer does pay back the loan completely, the lien holder, the bank, then releases the lien and the individual owns the car free and clear of any liens. Judgment lien. A judgment lien is a lien put on assets by the courts, which is usually because of a suit. A judgment lien can help a defendant earn money back in the case of non-payment by liquidating the implicated assets. Mechanics lien. A mechanics lien can be attached to real estate if the property owner fails to pay a professional for services rendered. If the debtor never pays, the contractor could go to court and get a judgment against the non-paying party, whereby property or assets can be auctioned off to pay the lien holder. Most service providers have the option to position a lien to protect payment, including but not limited to building and construction firms and dry cleaners. Realty lien. A property lien is a legal right to seize and sell real estate property if an agreement isn't satisfied. Some real estate liens are automatically put in place, like the case of a home loan lien. When a celebration borrows cash from a bank to acquire their home, the bank puts a lien on the house till the home mortgage is paid off. Yet, some real estate liens are because of non-payment to a lender or financial institution, and as a result, are uncontrolled and non-consensual liens. Tax liens. There are also some statutory liens, suggesting liens created by law, as opposed to those created by an agreement. These liens are extremely common in the field of taxation, where laws typically enable tax authorities to put liens on the property of delinquent taxpayers. For example, towns can use liens to recover overdue property taxes. In the United States, if a taxpayer ends up being overdue and doesn't show any indicator of paying owed taxes, the IRS, Internal Revenue Service, might put a legal claim against the taxpayer's property, including the taxpayer's home, automobile, and checking accounts. A federal tax lien has precedence over all other financial institutions' claims and can lead to a sheriff's sale. A constable's sale is a public auction whereby assets are repossessed, sold, and the generated funds are used to pay back a financial obligation to a creditor, bank, or the IRS. A tax lien also influences the taxpayer's ability to sell existing assets and to acquire credit. The only way in which to release a federal tax lien is to totally pay the tax owed or to reach a settlement with the Internal Revenue Service. The Internal Revenue Service has the authority to seize the assets of a taxpayer who ignores a tax lien. Typically, the IRS uses liens for overdue taxes as a last option following all other options being exhausted, like collection, installment payment strategies, and settlement. Chapter 9. Net Interest Margin. What is net interest margin? Net interest margin, NIM, is a measurement comparing the net interest income a financial firm produces from credit items like loans and mortgages, with the outbound interest it pays holders of savings accounts and certificates of deposit, CDs. Uttered as a percentage, the NIM is a success indication that telegraphs the possibility of a bank or financial investment firm growing over the long haul. That metric helps prospective investors determine whether to buy a given financial services firm. Basically, a favorable net interest margin suggests that an entity operates beneficially, while an unfavorable figure implies investment ineffectiveness. In the latter scenario, a firm might take restorative action by using funds toward outstanding debt, or moving those assets to more lucrative investments. Consider the following fictitious example. Assume company ABC boasts a return on investment of $1 million, an interest expenditure of $2 million, and average making assets of $10 million. In this situation, ABC's net interest margin totals minus 10%, showing that it lost more money due to interest expenses than it earned from financial investments. That firm would likely fare better if it used its mutual fund to settle debts, rather than making this financial investment. What impacts net interest margin? Multiple elements may affect a bank's net interest margin, chief amongst them, supply and needs. If there's a pretty big need for savings accounts contrasted with loans, net interest margin decreases, as the bank is required to pay out more interest than it gets. Alternatively, if there's a greater demand in loans versus cost savings accounts, where more consumers are borrowing than saving, a bank's net interest margin boosts. Monetary policy and financial control can affect a bank's net interest margin, as the direction of interest rates dictate whether consumers borrow or save. Monetary policy set by central banks also heavily influence a bank's net interest margins, because these edicts play an essential role in ruling the demand for savings and credit. When interest rates are low, consumers are more likely to obtain money and less likely to wait. In time, this typically results in higher net interest margins. Contrasted with that, if rates of interest go up, loans become costlier, thus making cost savings a more attractive alternative, which consequently reduces net interest margins. Net interest margin and retail banking. Most retail banks offer interest on customer deposits, which generally hovers around 1% yearly. If such a bank marshaled together the deposits of 5 consumers and used those proceeds to provide a loan to a small company with a yearly interest rate of 5%, the 4% margin between those two quantities is considered the net interest spread. Looking one step further, the net interest margin calculates that ratio over the bank's entire asset base. Let's assume a bank has earning assets of $1.2 million, $1 million in deposits with a 1% yearly interest to depositors, and loans out $900,000 at an interest rate of 5%. This means its financial investment returns total $45,000, and its interest costs are $10,000. Using the aforementioned formula, the bank's net interest margin is 2.92%. With its NIM squarely in positive area, financiers may wish to strongly consider investing in this firm. Historic net interest margins. The Federal Financial Institutions Examination Council, FFIEC, releases an average net interest margin figure for all USA banks on a quarterly basis. Historically, this figure has trended downward while averaging about 3.8% since first being recorded in 1984. Recessionary periods accompany dips in average net interest margins, while periods of economic growth have experienced sharp preliminary increases in the figure, followed by progressive declines. The overall movement of the typical net interest margin has tracked the movement of the federal funds rate with time. Case in point, following the financial crisis of 2008, U.S. banks operated under reducing net interest margins as a result of a falling rate that reached near zero levels from 2008 to 2016. During this economic crisis, the average net interest margin for banks in the U.S. shed almost a quarter of its value before finally getting up again in 2015. Chapter 10. Parallel Loan Definition. What is a parallel loan? A parallel loan is a four-party contract in which two parent businesses in different countries obtain money in their local currencies, then loan that money to the other's local subsidiary. The general purpose of a parallel loan is to stay away from borrowing money across nation lines with possible restrictions and costs. Each company can certainly go straight to the foreign exchange market, Forex, to protect their funds in the appropriate currency, but they would then deal with exchange risk. The first parallel loans were executed in the 1970s in the UK in order to bypass taxes that were enforced to make foreign investments more pricey. Nowadays, currency trades have mostly replaced this strategy, which is similar to a back-to-back loan. How a parallel loan works. For instance, say an Indian company has a subsidiary in the United Kingdom, and a UK firm has a subsidiary in India. Each firm's subsidiary needs the equivalent of 10 million British pounds to fund its operations and financial investments. Instead of each company loaning in its home currency and then converting the funds into the other currency, the two parent companies would enter into a parallel loan contract. The Indian business borrows 909,758,269 rupees, the equivalent of 10 million pounds, from a regional bank. Meanwhile, the British company obtains 10 million pounds from its regional bank. They each then loan the money to the other subsidiaries, agreeing on a defined period of time and rates of interest. Most loans of this type come due within 10 years. At the end of the term of the loans, the cash is paid back with interest, and the parent companies pay back that money to their home banks. No exchange from one currency to the other was needed, and because of that, neither the two subsidiaries nor the parent companies were exposed to currency risk as a result of fluctuations in the rupee-pound currency exchange rate. Firms may also instantly make loans to each other, skipping the application of banks altogether. When the loan term ends, the firm pays back the loan at a repaired rate concurred upon at the start of the loan term, thus making sure against currency risk throughout the regard to the loan. Pros and cons of a parallel loan. As discussed earlier, parallel loans stay away from currency risk and possibly legal constraints of cross-border financing. They also allow for lower rates of interest, as each regional firm may have an advantage in loaning on its home turf, as opposed to borrowing as the local subsidiary of a foreign firm. The credit ranking of the subsidiary may not be as high as a foreign firm. It might be considered as riskier. In hunting down parallel loans, the largest problem companies face is finding counterparties with similar funding needs. And even if they do find appropriate partners, the conditions preferred by both may not match. Some parties will get the services of a broker, but then brokerage costs need to be added to the cost of the funding. Default risk is also a problem, as the failure by one party to pay back the loan in a timely manner does not launch the obligations of the other party. Generally, this risk is balanced out by another financial agreement, or by a contingency clause covered in the original loan agreement. Unique factors to consider for a parallel loan. Businesses could accomplish the same hedging technique by trading in the currency markets, either money or futures. And certainly, as the Forex trading has expanded in the last 20 years, with digital platforms enabling trading essentially around the clock, parallel loans have become less common. Still, they can be easier, particularly if the two parties plan to lend directly to each other. Chapter 11. Defeasance. Defeasance is an arrangement in a contract that voids a bond or loan on a balance sheet when the borrower sets aside cash or bonds adequate enough to service the money debt. The customer sets aside money to pay the bonds. Because of this, the outstanding debt and money balance out one another on the balance sheet and do not need to be noted. Breaking down defeasance. In the clearest sense, defeasance is any kind of provision that abolishes the contract in which it is included. The arrangement includes various requirements that should be met, usually by the buyer, before the seller is needed to release his interest in a certain property. Defeasance involves a customer setting aside adequate funds, often in money and bonds, to cover his/her associated financial obligations. This works as a specific way to render the debt commitment null and void without the risk of prepayment penalties. Since the quantities owed and the amounts reserved offset, they're functionally gotten rid of from the balance sheet, as keeping track of the accounts is normally unnecessary. Example of defeasance. One area where defeasance is used is with business real estate purchases. Unlike home mortgages, industrial loans might have substantial prepayment charges because of the responsibilities to bondholders with a stake in the commercial mortgage-backed security, CMBS, that contains the loan. Prepayment can be an issue in these situations because financiers expect a specific number of interest payments to produce profits. If a borrower pays early, they lose that future money. So to avoid this, some bonds and loans have a prepayment penalty written in. To stay away from penalties, but functionally complete an early benefit, the commercial property purchaser can build a portfolio with an equal value to the staying responsibilities. The most common securities within these portfolios are high-quality bonds with a yield that covers the rate of interest associated with the loan. That construct enables shareholders to continue getting payments and allows the customer to functionally pay the loan off early. Creating defeasance accounts. The process of defeasance is generally considered complex and is rarely carried out solely by the borrower. Often, a variety of lawyers and economists are necessary to guarantee the portfolio is appropriately structured and supplies the funds needs to balance out the money debt owed. This resembles liability matching used by pension fund experts, where the future income stream associated with existing securities matches the future payments needed to be made. The defeasance provision. As part of a home mortgage agreement, the defeasance provision provides the customer the right to protect the title or deed for the property when the debt is paid in full. Before that time, the financial institution backing the loan has all the rights to the title, as it works as security for the associated debt. Comparable plans also exist with a range of other massive funded purchases. This includes most car loans. Once the debt is paid in full, the financing company ends its interest in the property and consequently launches the property to the buyer. Chapter 12. Trade Credit. What is a trade credit? A trade credit is a business-to-business, B2B, arrangement in which a customer can purchase products on account without paying cash up front, paying the supplier at a later scheduled date. Usually, businesses that run with trade credits will give purchasers 30, 60, or 90 days to pay with a transaction recorded through a billing. Trade credit can be thought of as a type of 0% funding, increasing a business's assets while delaying payment for a specified value of items or services to a little bit of time in the future, and needing no interest to be paid in relation to the payment period. Understanding trade credit. A trade credit is an advantage for a purchaser. Sometimes, certain buyers may be able to negotiate longer trade credit payment terms, which provides an even greater benefit. Usually, sellers will have specific requirements for getting approved for trade credit. A B2B trade credit can help a company to acquire, manufacture, and sell goods before ever having to pay for them. This permits businesses to get a revenue stream that can retroactively cover costs of items sold. Walmart is just one of the biggest utilizers of trade credit, seeking to pay retroactively for stock sold in their stores. Worldwide company deals also include trade credit terms. Generally speaking, if trade credit is offered to a buyer, it typically always offers a benefit for a company's capital. The number of days for which a credit is given is determined by the firm enabling the credit and is agreed upon by both the company allowing the credit and the firm getting it. Trade credit can also be an essential way for services to finance short-range development. Because trade credit is a kind of credit with no interest, it can often be used to motivate sales. Since trade credit puts suppliers at rather of a disadvantage, many suppliers use discount rates when trade credits are included to encourage early payments. A provider might give a discount if a client pays within a specific number of days before the due date. For example, a 2% discount rate if payment is received within 10 days of issuing a 30-day credit. This discount rate would be described as 2%, 10 net 30, or simply 2 divided by 10 net 30. Trade credit accounting. Trade credits are represented by both sellers and purchasers. Accounting with trade credits can differ based upon whether a company uses cash accounting or accrual accounting. Accrual accounting is needed for all public companies. With accrual accounting, a company must acknowledge earnings and expenditures at the time they are negotiated. Trade credits invoicing can make accrual accounting more intricate. If a public company offers trade credits, it must schedule the revenue and expenditures associated with the sale at the time of the deal. When trade credit invoicing is included, firms don't instantly receive money assets to cover expenses. Therefore, firms should account for the assets as receivables on their balance sheet. With trade credit, there is the possibility of default. Firms offering trade credits also normally offer discount rates, which means they can receive less than the accounts receivable balance. Both defaults and discount rates can require the need for balance dues write-offs from defaults or write-downs from discount rates. These are considered liabilities a company must expenditure. Alternatively, Trade credit is an advantageous option for organizations on the buying side. A business can acquire assets, but would not need to credit cash or recognize any expenses instantly. In this way, a trade credit can act just like a 0% loan on the balance sheet. The firm's assets increase, but the cash does not need to be paid until a bit of time in the future, and no interest is charged during the repayment period. A business only needs to recognize the expenditure when cash is paid using the cash technique, or when earnings is gotten using the accrual technique. In a general sense, these activities considerably maximize cash flow for the purchaser. Trade credit trends. Trade credit is most satisfying for businesses that do not have a lot of funding options. In monetary technology, new types of point-of-sale financing options are being provided for businesses to utilize in place of trade credits. A lot of these fintech firms partner with sellers at the point of sale to supply 0% or low-interest funding on purchases. Those partnerships help to alleviate trade credit dangers for sellers, while also supporting growth for buyers. Trade credit has also produced new financing options for sellers in the form of receivables financing. Accounts receivable financing, also known as invoice financing or factoring, is a type of funding that provides services with capital in relation to their trade credit, receivable balances. From an international standpoint, trade credit is encouraged. The World Trade Organization reports that 80% to 90% of world trade is in some way reliant on trade financing. Trade financing insurance coverage is also a part of many trade financing discussions globally, with many new innovations. LiquidX, for example, now offers an electronic market focused on trade credit insurance for international participants. Research carried out by the United States Federal Reserve Bank of New York also highlights some essential insights. The 2019 Small Business Credit Study finds that trade credit finance is the third most popular financing tool used by small companies, with 13% of organizations reporting that they utilize it. Associated principles and other factors to consider. Trade credit has a considerable impact on the funding of businesses and is for this reason connected to other financing terms and principles. Other important terms that affect business financing are credit score, trade line, and buyer's credit. A credit score is a general evaluation of the credit reliability of a customer, whether a firm or individual, based on monetary history that includes money debt payment timeliness and other aspects. Without a good credit rating, trade credit may not be offered to a firm. If organizations do not pay trade credit balances according to concurred terms, fees in the form of costs and interests are normally incurred. Sellers can also report delinquencies on trade credit, which might impact a buyer's credit ranking. Delinquencies affecting a purchaser's credit rating can also impact their capability to get other types of financing also. A trade line or trade line is a firm credit account record provided to a firm credit reporting agency. For large companies and public companies, trade lines can be followed by ranking firms such as Requirement and Poor's, Moody's, or Fitch. Buyer's credit is related to global trade and is basically a loan given to specifically finance the purchase of capital items and services. Buyer's credit includes different companies across borders and normally has a minimum loan amount of some $1 million. Chapter 13. Debt Instrument. What is a financial obligation or debt instrument? A financial obligation instrument is a tool an entity can utilize to raise capital. It's a documented, binding responsibility that provides funds to an entity in return for a promise from the entity to pay back a lender or investor in accordance with regards to a contract. Financial debt instrument contracts include detailed arrangements on the deal, such as security involved, the interest rate, the schedule for interest payments, and the time frame to maturity if relevant. Understanding financial obligation instruments. Any kind of instrument mostly categorized as financial debt can be considered a financial obligation instrument. Financial debt instruments are tools an individual, federal government entity, or business entity can utilize for the purpose of acquiring capital. Financial debt instruments provide capital to an entity that guarantees to pay back the capital over time. Credit cards, line of credit, loans, and bonds can all be types of debt instruments. Normally, the term financial debt instrument primarily focuses on financial debt capital raised by institutional beings. Institutional entities can include governments and both personal and public companies. For monetary business accounting purposes, the Financial Accounting Standards Board's normally accepted accounting concepts, GAAP, and the International Accounting Standard Board's International Financial Reporting Standards, IFRS, might have certain requirements for the reporting of different types of debt instruments on an entity's monetary declarations. The issuance markets for institutionalized beings differs significantly by the kind of debt instrument. Charge cards and credit lines are a type of financial debt instrument an organization can use to get capital. These revolving money debt lines normally have easy structuring and only a single loan provider. They are also not usually related to a main or secondary market for securitization. More complicated debt instruments will involve innovative contract structuring and the participation of several lending institutions or investors, generally investing through an arranged market. Instrument structuring and types. Financial debt is typically a top choice for institutional capital raising because it includes a specified schedule for payment and hence lower risk, which enables lower interest payments. Debt securities are a more complicated type of money debt instrument that involves more comprehensive structuring. If an institutional entity chooses to structure financial debt and were to obtain capital from several loan providers or investors through an arranged marketplace, it is typically identified as a financial obligation security instrument. Financial debt security instruments are complicated and sophisticated money debt instruments structured for issuance to several investors. Some of the most typical money debt security instruments include U.S. Treasuries, community bonds, and business bonds. Entities issue these debt security instruments because the issuance structuring enables capital to be obtained from several investors. Financial debt securities can be organized with either short-term or long-term maturities. Short-term debt securities are paid back to investors and closed within 1 year. Long-lasting debt securities need payments to financiers for more than 1 year. Entities typically structure financial debt security offerings for payments, varying from 1 month to 30 years. Below is a breakdown of some of the most common money debt security instruments used by beings to raise capital. U.S. Treasuries. U.S. Treasuries come in many forms, signified across the USA Treasury yield curve. The U.S. Treasury concerns financial debt security instruments with 1 month, 2 month, 3 month, 6 month, 1 year, 2 year, 3 year, 5 year, 7 year, 10-year, 20-year, and 30-year maturities. Every one of these offerings is a financial obligation security instrument offered by the USA federal government to the entire public for the purpose of raising capital to money the federal government. Municipal bonds. Community bonds are a type of debt security instrument issued by firms of the USA government for the purpose of funding facilities projects. Local bond security financiers are mainly institutional investors such as shared funds. Business bonds. Business bonds are a kind of debt security an entity can structure to raise capital from the whole investing public. Institutional shared fund financiers are typically some of the most popular business bond investors, but individuals with brokerage access might also have the opportunity to buy business bond issuance too. Corporate bonds also have an active secondary market, which is used by both individual and institutional investors. Businesses structure business bonds with different maturities. The maturity structuring of a corporate bond is an influencing part of the rate of interest offered by the bond. Option-structured debt security products. There are also a range of alternative structured debt security items in the market, mainly used as debt security instruments by banks. These offerings include a package of assets provided as a financial obligation security. Banks or financial agencies might choose to bundle items from their balance sheet into a single financial debt security instrument offering. As a security instrument, the offering raises capital for the institution, while also segregating the bundled assets. Chapter 14. Overall Liabilities. What are overall liabilities? Overall liabilities are the combined financial obligations and commitments that an individual or firm owes to outside parties. All assets of a company are either owned by the entity and categorized as equity, or go through future responsibilities and recorded as a liability. On the balance sheet, overall liabilities plus equity must equal overall assets. Comprehending overall liabilities. Liabilities can be referred to as a responsibility between one party and another that has not yet been finished or paid for. They are settled in time through the transfer of economic advantages, including money, goods, or services. Liabilities consist of many products ranging from month-to-month lease payments to utility costs, bonds provided to investors, and corporate charge card financial debt. Money received by an individual or company for a product or service that has yet to be provided, otherwise known as unearned income, is also noted as a liability because the profits has still not been earned and represents products or services owed to a customer. Future payouts on things like pending suits and product warranties should be listed as liabilities too, if the contingency is likely and the amount can be fairly approximated. These are described as contingent liabilities. Types of liabilities. On the balance sheet, a company's total liabilities are generally broken up into three categories: short-term, long-lasting, and other liabilities. Overall liabilities are computed by summing all short-term and long-lasting liabilities, along with any off-balance sheet liabilities that corporations might sustain. Short-term liabilities. Short-term or current liabilities are liabilities that are due within 1 year or less. They can include payroll costs, rent, and accounts payable, AP, money owed by a business to its consumers. Just because payment is due within a year, investors and experts are eager to determine that a business has enough cash on its books to cover its short-range liabilities. Long-term liabilities. Long-term liabilities or non-current liabilities are financial obligations and other non-debt monetary responsibilities with a maturity beyond 1 year. They can include debentures, loans, deferred tax liabilities, and pension responsibilities. Less liquidity is required to pay for long-lasting liabilities as these commitments are due over a longer time frame. Investors and analysts generally expect them to be settled with assets derived from future earnings or funding transactions. 1 year is usually enough time to turn inventory into cash. Other liabilities. When something in financial declarations is described as other, it generally means that it is unusual, does not fit into significant categories, and is considered to be relatively small. When it comes to liabilities, The other tag can describe things like intercompany loanings and sales taxes. Investors can find what a company's other liabilities are by checking out the footnotes in its monetary declarations. Advantages of total liabilities. In isolation, total liabilities serve little purpose, aside from to possibly compare how a company's commitments stack up against a rival operating in the exact same sector. Still, when used with other figures, total liabilities can be a helpful metric for evaluating a firm's operations. One example is in an entity's debt-to-equity ratio. Used to evaluate a firm's financial leverage, this ratio shows the capability of shareholder equity to cover all outstanding debts in case of a company recession. A comparable ratio called debt to assets compares total liabilities to total assets to show how assets are financed. Unique considerations. A bigger amount of overall liabilities isn't in and of itself a financial indication of poor financial quality of an entity. Based upon prevailing interest rates available to the firm, it may be most favorable for the business to obtain debt assets by sustaining liabilities. Even so, the overall liabilities of a firm have a direct relationship with the credit reliability of an entity. Generally speaking, if a business has reasonably low total liabilities, it might acquire favorable rates of interest on any new debt it carries out from loan institutions, as lower overall liabilities lessen the chance of default risk. This has been Accounting: How to Calculate Rollover Risks, Credit, Leasebacks, and Other Financial Variables. Written by Gerard Howells. Narrated by Wes Grant. Copyright 2020 by Gerard Howells. Production copyright by Gerard Howells.